What you have right now is an earnings-driven market.
People want to get exposure to growth and strong economy earnings go ahead.
Earnings momentum doesn't seem like it's peaking.
If you think of what's driving these global markets right now, it's a semiconductor super cycle for the history books.
It's the casting away of fear in its entirety that will end up being the market's biggest problem at some point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, yields up, stocks down. Global price pressure building, sending US 10-year yields through 450 as borrowing costs in Japan break out to levels not seen since the late 90s. Gilts sinking to new lows, heading into a battle to topple the British Prime Minister. The bond market shaken this morning.
There are two things here. On one hand, you could say that an oil price shock would eventually be disinflationary, but only when you get demand destruction. And right now, at least in the world's biggest economies, you are not seeing that level of demand destruction because, frankly, it is in the political interest of different parties to keep demand strong. So you're seeing inflation, you're seeing it come through in the PPIs around the world. The second thing is it's not clear when this oil price shock is going to end. President Trump coming out and saying just overnight, we don't need the Strait of Hormuz open anyway. It is not our problem because we have our own oil. So how much emphasis is there on resolving this issue?
This has been building for a while. We've been talking about it continuously over the last several weeks. Check out the US curve now. 2s, 10s, 30s. 10s through 450. 30s through 5%. Leadership issues in the UK. An inflation problem globally. An incoming Fed chair with a very unclear reaction function at this point. And we often say this. The market will always test the new Fed chair in different ways at different times. Maybe that test is coming slightly early.
And in fairness to him, he's not exactly coming into an easy scenario. You've got resurgent inflation globally. You've got a fiscal impulse that is to simply stimulate, not necessarily to curtail or have any kind of restraint when it comes to any kind of debt incurrence. You have very high debt loads around the world, and you have a new regime. We are not going back to zero interest rates anytime soon. And he has to fend off with a president who doesn't want to see this economy stall out and with a market that is petrified that he's going to allow inflation become unmoored.
There's another force in the mix here that I hope we spend some time on throughout this morning, and it's the crowding out from other places. We caught up with the OpenAI CFO who wants to raise more capital, even after a massive monster raise in private markets. Alphabet on a $60 billion debt binge over the last 4 months and ultimately likely to raise more capital in the year ahead. There's some crowding out here that I think is noteworthy.
There is an insatiable demand to raise money to fund some of the hyperscaler build out. And so far, they've seen absolutely resounding demand. It seems like there isn't enough cash to be piled into these bonds. Alphabet can go around the world. It's sort of the world tour. Go to Japan, go to Switzerland, go to the European continent, raise as much cash as you can, and everyone's clamoring to give it to them. They're trying to get ahead of what they already anticipate to be some sort of saturation. And they want to avoid the saturation by spreading out the love, spreading out the debt sales. At what point does that take away from some of the government bonds that, frankly, have a less reliable balance sheet behind them? I mean, again, who would you rather lend your money to right now? Alphabet or, a developed market economy?
And this is how the stage is set so far this morning. Crude inching higher, up by 3 to 4%. Bonds down, yields up. Stocks sinking, down about 1% on the S&P 500, pulling back from all-time highs. Coming up this hour, we'll catch up with Sébastien Page of T. Rowe Price as bond yields break out. Mary Lovely of the Peterson Institute as the US and China extend their trade truce. And Dan Ives of Wedbush as Cerebras surges on its trading debut. We begin this hour with stocks sinking and bond yields breaking out. Sébastien Page of T. Rowe Price writing, we're neutral between stocks and bonds, balancing strong earnings momentum against high valuations and macro risk. Stay diversified, stay invested, and hedge inflation risk. Sébastien joins us now for more. Seb, welcome to the program. That last line's important. Hedging inflation risk. How much of a challenge now is coming from the bond market?
I think it's a meaningful challenge, Jonathan. You know, when you're in the investment business and you're at a cocktail party and someone asks you for advice or stock tips, the good thing to say is always stay invested, stay diversified. But right now I would say stay invested, stay diversified, hedge inflation risk. My message to our clients is diversify your hedges. Lisa has hinted at this. Treasuries won't do the job if we get inflation volatility. We like a portfolio of hedges. We like to hold cash, be short duration. We like real asset equities, energy companies, metal companies, we actually like hedged equities. Buy protection, and then you can still participate in the rally. You give up part of the upside. But what you end up with is a diversified set of hedges while staying invested, because you know what? The earnings, Jonathan, you've been talking about this on the show all week. They're amazing. We thought we'd get 13% year-over-year growth at the end of March. We're trending at 30% year-over-year growth. Those are massive, massive earnings surprises. So stay invested, stay diversified. Hedge inflation.
Seb, I totally agree with you. And you and I have been talking about this over the last several months, the journey of the last 2 to 3 months. We had the energy shock. At times, we started to see a rate shock emerge. We're seeing that again, globally, not just in the US and Japan and the UK. Is that going to translate into a growth shock? Do you think we can withstand the latter?
If you do get a growth shock, you will want treasuries. I'm not saying you should just remove all treasuries from your portfolio and just put all this in gold. It's a diversified set of hedges. But Jonathan, you frame this first as a chain reaction, and it's a slow-moving chain reaction. And I really liked how you framed it, right? You were talking about an oil shock that leads to an inflation shock, that leads to a rate shock, that eventually tightens financial conditions, and that leads to a growth shock. I'm not too worried about the growth shock because the underlying U.S. economy is running, it looks like, at 6% nominal growth right now. And the economic surprises are trending up, not down so far this year. But this is the main risk in financial markets, Jonathan. It's the collision course between inflation and Fed policy. And Jeff Gonlach will say, the way you look at this collision course, what could force the Fed's hand, despite all the politics that are going in the background, is the 2-year yield. And it's trending up this morning. It's at 4.1%, and the top Fed rate is at 3.75. There's a dissonance there.
Well, Sébastien, one speculation has been that you might want to buy the 2-year because this Fed is not going to raise rates under any condition, regardless of how hot inflation gets, unless inflation goes to 9% again. But you will see that relief valve when it comes to the long end of the yield curve in terms of yields going up and, frankly, the dollar growing weaker. Do you adhere to that kind of idea?
No, we're hedging. Look, we're hedging inflation, and I do think the Fed will have to face some very difficult decisions. My economist friends tell me never to annualize 2 monthly data points, but I'm going to do it just for fun. Annualize the last 2 CPI prints, and you get a 5% rate. I'm a runner. I like to look at my watch when I'm running, and what's the pace right now? Well, the pace right now of inflation, let's say it's 4, let's say it's 4.5, let's say it's 5%. The Fed's target is 2. So you can't maintain an easing bias, at least in the short run, Lisa.
In the meantime, Sébastien, one thing that seems kind of counterintuitive in terms of your positioning is you're actually going more heavily into the U.S., kind of undiversifying some of the exposure on the equity side and, frankly, concentrating a lot of your exposure to the AI trade. Why is that?
We've done well with the broadening trade, and now we're taking some profits. We've reduced those positions, say, small cap and especially international, and we're moving money from international into the U.S. for a few reasons, Lisa, but it's clear that Europe is much more sensitive to the energy shock than the U.S. being a net exporter of oil. We think that the AI theme is best expressed right now amongst the many ways to express the AI theme in U.S. large-cap growth stocks. The earnings for U.S. large-cap growth stocks, yes, you'll say it's a high bar, but if you look at the projections for the earnings for the next 12 months, they're at like 28%. And this is an all-time high for the 25 years of data that I have on my chart. Now, this is a high bar, but those are companies that tend to meet that high bar. So you have high earnings growth, high margins, and the valuations, well, for large cap growth in the U.S., they're below the 5-year average. And the MAG 7, if you look at the equal index on Bloomberg, it was at 40 at the peak. Now it's at 26. So it's not bubble-ish valuation in my mind. And so we're moving some money, especially from the international into the U.S. large cap growth segment.
That demand is going to be met with supply. And I'll tell you what I mean by that. Seb, 10 years ago, in the last decade or so, we spent a lot of time talking about so-called asset scarcity. Now we're shifting towards abundance. So let's take the big players in the US equity market. They were buying back a lot of stock and they weren't issuing a lot of debt. That's flipped. And we're going to get several major IPOs later this year as well, as you switch from scarcity to something that looks a little bit more like abundance. How does this market handle that?
Yeah, look, those companies are transforming, and we're looking at the CapEx. It's massive. I mean, the last estimate I saw was for $3 trillion by 2028. Now, this is a stimulus for the economy, but in the end, those companies have massive margins, massive earnings growth relative to the rest of the market. And also, relative to history, people like to do dot-com bubble kind of, oversupply of infrastructure and overbuilding infrastructure. I think we will get there, and that's a risk. But for 6 to 12 months ahead views, I think this keeps going, Jonathan. And those companies, the margins are double. The margins are basically double what they were at the peak of the dot-com bubble. So you can't really compare the valuations here.
Seb, it's good to see you. As always, sir, thanks for being with us. Sébastien Page there at T. Rowe Price, working through some issues. We'll spend some time with Dan Ives on Cerebras. What a debut for that stock. Foaming the runway for some major IPOs set to come maybe in the next 12 months.
On one hand, you could say that the actual shares sold much higher than the original marketing price. And then you see the pop, the 68% pop, and then the follow-on today. And you think about all the billionaires that have been created, and you start thinking to yourself, was that underpriced? And what does that mean for OpenAI and for Anthropic that could come later this year?
I think that's just the thing I'm focused on at the moment. I don't think it's a massive challenge right now, but it's a story for the next 12 months. These major tech players issuing more debt. These big companies in private markets becoming public and issuing more equity. They're the kind of things that I'm laser focused on for the next 12 months.
Especially because is Cerebras truly a guide for OpenAI and Anthropic? OpenAI in particular, which has run into some snags and had some reporting about maybe slower bookings than they had expected.
Futures down this morning by 1% on the S&P 500 with an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Good morning, John. President Trump has departed China after 2 days of talks with Xi Jinping, the Chinese president hailing the summit, touting a new bilateral relationship. Details about any commercial deals reached remain scarce and could be announced in the future. President Trump saying President Xi offered to help in getting the Strait of Hormuz reopened. Trump telling Fox News that the U.S. doesn't need it opened and that the blockade serves to help Israel and other Gulf allies. And as you all were just discussing, we are seeing Cerebras shares actually lower nearly 3% in the pre-market amid the broader chip and market sell-off. Its shares surged 68% yesterday in its trading debut, with the AI chip maker raising $5.5 billion in this year's largest IPO yet. That's your Bloomberg brief, John.
Yahara, thank you. More from Yahara later this hour. Up next on the programme, maintaining a trade truce.
This has been an incredible visit. I think a lot of good has come of it. We've made some fantastic trade deals, great for both countries.
In just a moment, we'll catch up with Mary Lovely of the Peterson Institute and Annmarie on the ground in Beijing, China. Live from New York City this morning, good morning. As of Thursday's close, all-time highs on the S&P 500, heading towards a 7th consecutive weekly gain, the longest weekly winning streak potentially going all the way back to December 2023. This morning, we're taking a bite out of that gain. We're down 1% on the S&P. We're negative 1.4% on the Nasdaq 100. At the epicenter of some of the jitters this morning, these moves in the bond market. 2s, 10s, 30s stateside, 2s through 4%, 10s through 450. 30 sticking above 5%. Similar moves taking place globally, much larger moves in the UK. Leadership problems there. In Japan, really hot PPI coming out of the Japanese economy. Japanese yields at levels we haven't seen since the 1990s.
Yeah, and this comes after the hot PPI print that we got in the United States. Just to give you a sense of how hot it was, producer prices in Japan jumped 4.9% last month. That was compared to an estimate of 3%. It gives you a sense of just how much faster some of this inflationary pressure is than people expected.
12-year highs, right, out of Japan. Major numbers out of Japan. Numbers that were unthinkable going back a couple of decades. Looking at the energy market, this is not helping. Brent crude higher by 3% on WTI. Brent crude up by 3% as well. The president asked about the situation in the Middle East, asked about reopening the Strait of Hormuz. This is where we really haven't moved things forward. Zero progress in the past few days.
Yeah, not only that, but he just went to, we don't need the Strait of Hormuz, especially if the allies aren't going to help, because they'd rely on it significantly more than the United States. Possibly this is why you're seeing a bigger sell-off over in Europe, since that economy is much more dependent on that. He went on to say, from a military standpoint, Iran is finished, but they're clogging up the Strait of Hormuz. A real question here about what the deliverables were. A lot of niceties between agreements between the U.S. and China about some sort of Iranian help or some sort of mutual understanding. Not seeing any details that can give people comfort this morning.
A quiet rally in the energy market throughout the whole of this week, and we add to it. WTI at 104, Brent crude closing in on 109. Under surveillance this morning, maintaining a trade truce.
This has been an incredible visit. I think a lot of good has come of it. We've made some fantastic trade deals, great for both countries. He's a man I respect greatly. Become really a friend. We've known each other now 11 years, almost 12 years. That's a long time. And we've settled a lot of different problems that other people wouldn't have been able to settle.
Here's the latest this morning. President Donald Trump and Xi Jinping announcing important trade deals. The two nations agreeing to stabilize relations without any major breakthroughs. Annmarie on the ground in Beijing, China, and joins us now for more. Annmarie, the president's own words that we've been able to settle a lot of different problems. What problems have we settled on this trip?
It's a great question, Jonathan. Lots of smiles on this trip. Not a lot of substance, at least given to the press, in terms of what Xi Jinping and President Donald Trump decided on. When it comes to trade, though, that's what this White House really wants to focus on. I spoke to Ambassador Jamieson Greer earlier this morning. He reiterated that what the president had also said to Fox News in terms of Boeing jets, but only 200, Jonathan. Remember, the expectation going into this trip was maybe an order as big as 500. Ambassador Greer also talked about massive agricultural products that China was going to be willing to buy. We're still waiting on more details, though, and clarity from the Chinese side about what exactly they are going to purchase. And then when it comes to an item like rare earths, remember, this is when the negotiations last year got really tense, because China started to use rare earth licenses as a real negotiating tool. Jamieson Greer said he's giving them a passing grade. So almost feels like we're going back to where this relationship was before the trade war. One place where we know there's clarity on, and a place that didn't get a whole lot of discussion, according to Ambassador Greer, was chips. Tons of speculation that semiconductors and export controls was going to be on the negotiating table because Jensen Huang's last-minute appearance on this trip, and Jamieson Greer says it wasn't. Take a listen.
You want to make sure you strike a balance between national security, protecting high tech, but also making sure that we're benefiting from overseas markets. And so those are the kinds of things that went into the H-200 decision. As to whether the Chinese are going to buy or not, again, they're making their own determinations. They're very committed to domestic production.
Ambassador Greer, they're making it very clear it's going to be up to China to determine whether or not they are going to buy those H-200s.
Annmarie, fantastic conversation. Looking forward to hearing more of that later on in the programme. We'll catch up with AMH in the next hour. This came from Emily Goodwin of the New York Post. You'll be told this was a great meeting. The relations between the two nations have improved. Take a listen to this. American staff took everything that the Chinese officials handed out. Credentials, burner phones from White House staff, pins for delegations, collected them before we got on Air Force One and threw them in a bin at the bottom of the stairs. Nothing from China was allowed on the plane. That's the real state of the relationship between China and the United States.
There is a lot of speculation about exactly what was accomplished and potentially how tense some of these relations have remained despite some of the niceties. And that clearly is the uncertainty feeding out through a lot of the different reporting.
Joining us now to discuss, Mary Lovely of the Peterson Institute. She writes the following: the summit has succeeded in maintaining a tactical truce but failed to achieve resolution in the major irritants in the relationship. Mary joins us now for more. Mary, welcome to the programme. Let's just start with those major irritants, because there will be another summit potentially in September. What are they?
Well, Annmarie just talked about chips. Clearly, the Chinese have balked at the U.S. export controls. They have since moved on. They are now devoted to their own development of their own domestic chips. But if we look back at the last year, we can see that the main irritants, or the most proximate irritants, were President Trump's acceleration of the tariffs that had been placed on China in his first term, and then the Chinese invoking new export controls on critical minerals. A potentially very disruptive move for U.S. industry and the U.S. move to rearm following the war in Iran. So where did we get with any of that? As far as we know, there may have been some trade discussed, particularly by Secretary Bessent and his Chinese counterpart. But between the two principals, I think we have seen that there was no discussion of export controls and very little accomplished on the trade front. So the irritants really are still there.
Mary, I've heard conflicting reports about whether this was a good meeting or a bad meeting. Some people say at least nothing bad happened in terms of some sort of big blow up. On the flip side, there wasn't even an affirmation of some of the truces that we've seen when it comes to tariffs and rare earths over the past couple of months. What's your take on this?
Well, President Xi stressed stability, but he wasted absolutely no time in giving the American president the tongue lashing over Taiwan, which means that what we saw in China earlier this year, a sense of confidence and growing power, clearly was on display. The relationship overall was framed in exactly the terms that Beijing likes to use. The first is primacy. The U.S.-China relationship is the most important in the world. Is it the most important to the United States? What about our allies? Win-win. President Xi always likes to talk about the relationship in win-win or mutually gainful terms. Yet the President Trump, since 2017, has been talking about China as someone who's ripped the United States off. So how is that going to be win-win? And then lastly, President Xi likes to describe the relationship as one of partners, not rivals. What about the AI race? What about actions in the South China Sea? How have we suddenly become partners, and these issues that have to do with conflicting goals are suddenly papered over? So I think rather than just a visit that accomplished nothing, this actually set us back in terms of where we are with the Chinese.
In the meantime, what actually happened with all the CEOs from the United States who went over there? Do you have a sense of whether they accomplished anything or were involved in any of these meetings?
We don't have any sense of that. I think, Annmarie talked about how the chip sales, there's been crickets on that. So we really don't know why they stopped to pick up Jensen Huang in Alaska. The other CEOs were there, I suppose, to show their support for the U.S.-China commercial relationship, which remains important and is a good thing. But as far as addressing some of the problems these firms have experienced in serving the Chinese market, I think we've heard nothing.
Mary, what do you suppose the future is of the political question around this relationship domestically in the US? The president did such a powerful job many years ago of really highlighting how damaged people and communities were in this country from Chinese overcapacity and the hollowing out of manufacturing domestically in the US. That became a rare bipartisan issue in Washington, D.C. Is that a political priority anymore going into the midterms later this year and ultimately for the next general?
Well, I've always thought the harm was real, but the diagnosis was flawed there. We know that just attacking China is not an answer to what the U.S. needs to be doing to heal itself. So I think that now the president has decided that we need stability in this relationship, that going in an alternative route will actually cause more harm than good. We need to turn at home and say, okay, then what are we doing at home to meet the challenges that are before us, the same challenges we had before.
Mary, appreciate it. As always, Mary Lovely there of the Peterson Institute. There's a lot of building to be done. There's a lot of building being done already.
Yeah, and this, again, people talk about the reindustrialization of the United States. Where does China fit into that?
Coming up on the programme, we'll catch up with Ives of Wedbush as tech IPOs ramp up. Plus, Yahira has your morning movers. Cerebras climbing higher once again through yesterday, this morning, down 2%. Two-day winning streak on the S&P 500, back-to-back all-time highs on the S&P, on the Nasdaq. Pulling back this morning, we're down by 1% on the S&P 500, on the Nasdaq down by 1.4, on the Russell negative 1 percentage point. In the bond market, 2s, 10s, 30s look like this. Had a warm CPI print earlier this week, a smoking hot PPI print in the US and in Japan. Yields up across the curve worldwide, not just stateside, up by 6 basis points on a 10-year in the US, up by 13 in Japan on a 30-year. In the UK, some real leadership issues in the UK. Check it out, the 10-year up by 15 basis points, 514 on gilts in the UK.
I never thought I would know so much about the internecine politics of a political race in the UK, but evidently now I know about Andy Burnham and Streeting, excuse me, I'm getting it, who might be running against him, and that Andy Burnham needs to have a parliamentary seat before he can become the prime minister, so he resigned from being the mayor. Look, all of this to say there's a lot of uncertainty about who's going to run in the who's going to run the United Kingdom and what kind of fiscal policy they're going to come out with, because Andy Burnham, I believe, has called himself part of the soft left, labeling himself as something of a socialist, and there seems to be a disbelief in the bond markets that he can resurrect himself after saying that he thinks that the bond markets have too much power. So at this point, there definitely is a bit of bond vigilantism, but it isn't just isolated to the UK. It is a global phenomenon.
I don't know where this term is coming from, the soft left. We can spend some time on that later in the programme. But yes, certainly, it's not just the UK. The UK's got its own very narrow issues, but they're shared elsewhere as well. Japan's got deficit problems. It's now got inflation problems. All of this is building. And what's interesting about this moment in the bond market, just take a step back and compare where we were 10 years ago. When you and I first met and we're talking about fixed income, the anchors around global fixed income, JGBs, German bunds. Not anymore. Anchors away, yields up. And that's been building now for several years. And it makes it very, very difficult for politicians like that to come out and say, yeah, we're not going to be beholden to the bond market. Well, then the bond market's got something to say about that.
Because it is global and you can't push against a steamroller. We were talking about how Japan, there was no inflation. Well, that's a different story right now. And over in Germany, there was not spending. Well, that's changed as well. There is a feeling that if there were to be some sort of economic downturn, yes, you would see the haven bid into bonds, but that could potentially be a problem child, because guess what every government's going to do? They're going to try to borrow more to fuel some sort of growth at a time when deficits are pretty high. This is a difficult time where it's hard to understand exactly what levers fiscal and monetary authorities have to change this back to a low-rate regime once again.
Good luck doing that. Stateside, the 10-year and 30-year closing at a new high for the year throughout this week, and now 2s starting to break out above 4. The 2-year, the move at the front end of the curve. Let's just isolate that just for a moment. Got an incoming Fed chair, Kevin Walsh. Got a market pushing back, a 2-year above the policy rate, and a central banker put in the position the president believes he's going to make a push to cut interest rates. This market's going to test that. And you're starting to feel that test this morning.
We've priced in a full rate hike come April of next year. Not only is this market saying, we'll take your easing bias and throw it in the trash along with any kind of burner phone. Going forward, it seems like they believe this Federal Reserve will be pressured to hike rates. Sébastien Page saying that the 2-month annualized inflation rate would be closer to 5%. What Fed can arguably look at this, say, if inflation is a choice, this is what we're choosing? That's not going to fly for markets.
4.05% on 2s so far this morning. Counting you down to the open about 3 hours away with your morning movers. Yahira has more. Hey, Yahira.
Hi, John. The names that have run up the most this year, the chip makers, are all under pressure amid this market sell-off. And it all started over in Asia with names like Samsung and SK Hynix sinking, and it's spilling over into the U.S. with NVIDIA, Broadcom, and Intel all lower, and even Cerebras falling 3%. The newest AI chip darling surged 68% yesterday in its market debut. We have seen these sort of pullbacks before in the chip sector. It's failed to materialize into something broader, something bigger, which some are calling for. We'll see if it's different today. Also getting caught up in that sell-off is Applied Materials. Shares are down 3% after it delivered a massive beat and a raise due to AI, which is fueling 30% growth in its chip equipment business this year, helping to push margins to their widest level in 25 years, yet the market giving it no credit for that. And we end on shares of Papa John's. They are rising nearly 5% in the pre-market on a Reuters report that Earth Capital is now working with the company's largest U.S. franchisee on a potential take-private deal. This is a company that has struggled with weaker sales and tougher competition from the likes of Domino's and likely your local pizza joint. John?
Yahara, thank you. Thank you for the update. More from Yahara later this hour. On our radar this morning, President Donald Trump and Chinese leader Xi Jinping failing to reach a breakthrough on the Iran war. China calling for a reopening of the Strait of Hormuz. President Trump saying it's not a priority for the U.S.
They need the strait more than we need it open.
We don't need it at all.
We don't need it at all.
We don't need it at all.
Fair enough.
We're doing it to help Israel and to help Saudi Arabia and to help Qatar and other countries.
The president adding China agreed not to supply Iran with military equipment. Elsewhere, UK gilt yields on track for their biggest weekly increase going back to March. Prime Minister Keir Starmer facing increasing pressure to step down as fellow Labour Party members prepare a formal challenge to his leadership. And Alphabet going on a record-breaking debut binge. The Google parent company raising about $3.6 billion in the largest yen-denominated bond deal by a foreign company. Alphabet tapping global debt markets for about $60 billion over the past 4 months.
Yeah, and this highlights how much companies are shifting overseas as they start to see a little bit of tiredness from U.S. investors. I don't want to overplay this because still U.S. investors have seen the outperformance of tech-related debt over the past 6 months and said we need to get a piece of that. At the same time, they don't want to end up with exhausted U.S. investors that have overly concentrated indexes and then have to go create a market over in Japan and over in Switzerland and over in the UK. What's interesting to me is there hasn't been this type of issuance from tech investors over in the likes of Japan or Switzerland or the European continent ever. This is all of a sudden skyrocketing the proportion of U.S. tech debt in those indexes, which again, how can you diversify geographically? You made this point yesterday. I thought it was really salient. How do you diversify geographically when you're exposed to the same thing everywhere you go?
You feel like you're just in the same trade everywhere, South Korea, Japan, whatever it is. As for Alphabet, I believe that number over the last 4 months is bigger than anything they've issued in the history of the company before that. That's a major switch. We mentioned this with Sébastien. I think this is going to be an important theme for the next 12 months or so. We've gone from asset scarcity to abundance. These companies weren't building. Now they're building masses upon masses of things across this country and elsewhere. Now, let's just isolate it to the tech sector. They were buying back a lot of equity, massive buybacks, and not issuing a lot of debt. Now things are starting to change. It's the opposite now. They're buying back less, and now they're issuing more. And on top of that, what will you see for IPOs? You're going to see more IPOs in the year ahead now from the likes of SpaceX, from Anthropic, from OpenAI. I remember coming out of the pandemic and people saying things like there was an asset scarcity. There was a scarcity of good assets. They were getting bid up by a lot of money. And now you're getting issued a lot of paper in lots of different places in the next 12 months. The forces are changing and changing quickly.
Yeah, the one offset to that is that the bookings have been accelerating faster than the growth in debt. And the bookings have been accelerating faster than the pace of the build out of some of this infrastructure until now. And you've seen that from Microsoft. You've seen that from Meta. Any kind of miss on the pace of bookings, the bar is that much higher for it to exceed the increase in spending. And if it doesn't, well, those shares are going to get hammered. Again, it goes to the point of how much are these becoming increasingly utilities versus, say, some of the growth stocks that they used to be. That doesn't seem to be on the radar, at least in performance, on a number of the big high flyers.
The headline act of the last 24 hours, Cerebras, delivering the best opening day since 2000. The stock jumping 68% after raising $5.5 billion in the year's largest IPO. The AI chip maker setting the tone for a year of blockbuster public offerings, including SpaceX, OpenAI and Anthropic. Dan Ives of Wedbush writing, Cerebras is a watershed moment for the tech sector. The appetite for AI-exposed companies are high in the market. Dan joins us now for more. Dan, for an IPO of that size, of more than $4 billion, that is the best performance we've seen on a single day going back to 2000. Does it feel frothy, or is this a different moment?
Look, it doesn't. I mean, we've talked about it a lot. I mean, this is an AI revolution. And when it comes to the chip trade, that's going to continue to move higher because demand to supply, and we've talked about it from, NVIDIA, 10 to 1. And that ripple effect is across the board from inference to infrastructure. And that's what investors are focused on around the world. And this is something you said, it's really just the appetizer to what's going to be as we go into SpaceX, OpenAI, Anthropic, and others in terms of tech.
You are the bull on steroids, Dan. I think you'll be comfortable with that particular description of your approach to this market. When do you start to get nervous about what's happening here?
Look, I get the sort of view. To me, if I was sitting in an office building and just looking at a spreadsheet, okay, then maybe that's how you could sort of, the bears, that's how they're looking at it. I go look at when I was in Asia just a few weeks ago, demand to supply has accelerated 20%, quarter over quarter. So when I see companies, if they start to slow down their pace of spending, that's where I can start to get negative. But to some extent, it just continues to increase. And I think in this 9-inning game, baseball game, 3rd inning, 1 out, man on second.
At this point, Dan, Cerebras is a bit different than OpenAI or Anthropic, given the fact that it produces chips, which it doesn't produce CPUs or GPUs. Last night, I was learning about wafers and wafer system engines, which is essentially the full page-sized chip that they sell. How much are we seeing a very different type of response in markets to the IPO of Cerebras that can't really foreshadow what we could see with some of the big IPOs coming later this year?
Sure, it's a great point. I mean, look, everyone, you can't put them all in the same bucket. But when it comes to inferencing and what we see in terms of the overall demand for the trillions of dollars spent, you need to power. And when it comes to the chips, that right now on the supply chain is not just about NVIDIA. We've talked about chip rally. We still think 15, 20% higher at least. From AMD, you've seen it go out to Intel, and obviously you've seen the reaction here. But I think it just speaks to the 2nd, 3rd, 4th derivatives around the AI trade. I mean, and that's our view. And I think software is included there. It's why I believe we'll be looking at NASDAQ 30,000 over the next 6 to 9 months. That's driven not just by big tech, by the 2nd, 3rd, 4th derivatives of what's going on in this revolution.
One thing people have noted, Dan, is that there are going to be winners and losers. You've talked about that as well. I think about some of the IPOs that are on deck and then some of the negative press around one name in particular, OpenAI, now in news with respect to a breakdown in the relationship with Apple. Are you getting a little more nervous that they're losing their thunder to Anthropic and that even with overall things really accelerating, that will be one loser potentially in the not so distant future?
Yeah, look, right now, I mean, the narrative is a bit negative, but I think that's actually much different than the reality. I think they're going to be one of the core winners when it comes to enterprise. They've obviously gone through a lot of changes relative to Microsoft and relative to some of these deals. You see the Apple news, the Musk trial. So we're going through one of those periods. But when I think about winners over the long term, I mean, they're at the centerpiece. And even though Anthropic right now, clearly the best model and what they've done is almost historical, I think you cannot paint these companies with a brush just based on near-term news. This is just the beginning. And OpenAI is going to be one of the foundations of the AI revolution.
Hey, Dan, it's good to catch up, as always. What a move in yesterday's session. Dan Ives there of Wedbush. Happening right now on Air Force One. The president just engaging with reporters, getting some headlines from that particular conversation, saying she and I agree on trade very much. He didn't ask China for favours when it comes to Iran. He goes on to say, on Taiwan, we'll make a determination about arms sales to Taiwan. We think we'll be fine on the issue of Taiwan.
That's probably not enough detail to give people any sense of exactly what's going on. That could mean a couple of things, including that that was part of the discussions and that could be revisited. There already have been arms sales that have been promised to Taiwan. Will the U.S. go through with those particular transactions?
We'll try and get you some more on this. The president on Air Force One making his way back to the United States. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. Well, as President Trump departs China, another world leader is coming. The South China Morning Post reporting Russian President Vladimir Putin will visit Beijing next Wednesday. This will be Putin's first trip abroad this year. Meanwhile, we are seeing shares of Boeing falling just slightly as investors react with some disappointment to President Trump's announcement that China agreed to buy 200 Boeing jets in a multi-billion-dollar deal. Bloomberg Intelligence reports the market had been expecting an order of 300 aircraft or more. And Apple and OpenAI's partnership is on the rocks. Sources telling us here at Bloomberg, the AI startup is exploring possible legal actions after not seeing the expected benefits from its deal. No final decision has been made. That's your Bloomberg brief. John.
Yahara, thank you. More from Yahara in the next hour. Up next on the programme, the UK's leadership revolt.
We are stuck in a world of governments that don't focus enough on growth. It's all going to be quite drawn out, and if we got to an end conclusion, we would still have a Labour government that at the moment is fixated on lots of things that don't include growing the economy more quickly.
We'll have that conversation in just a moment with Jayati Bharadwaj of TD Securities, live from New York City. You're watching Bloomberg TV. Landing right now on Air Force One, the president conducting a conversation with reporters, getting a readout of that, just some headlines. Dropping across the Bloomberg terminal. Going to share some more of these headlines with you. What's interesting here is what the president is telling us wasn't discussed with the Chinese. We didn't discuss tariffs with China. We didn't talk about the H200 chip coming out of NVIDIA that we were talking about through this week. Didn't discuss that either. It's curious that they didn't talk about tariffs. It seems almost difficult to believe that didn't come up in conversations.
And it checks out with some of the commentary about some of the purchase commitments from from Xi Jinping to the United States, whether it's GE engines or whether it's soybeans. But what President Trump was saying they talked about Taiwan is sure to raise a lot of eyebrows, saying that he doesn't want to see a fight over Taiwan, that would be a strong confrontation. And we'll see what we're going to do when it comes to arms sales.
We'll come back to these headlines throughout this morning. Equities this morning down by 0.8% on the S&P, negative by more than 1% on the Nasdaq. Some weight on the tape born in the bond market this morning. Yields up across the curve, not just stateside, but in the UK by a whole lot more. Check out the UK. The UK up by double digits on a session. The 10-year right now up by 13, 14 basis points, 513 on 10s. Under surveillance this morning, the UK's leadership revolt.
We are stuck in a world of governments that don't focus enough on growth. It's all going to be quite drawn out, and if we got to an end conclusion, we would still have a Labour government that at the moment is fixated on lots of things that don't include growing the economy more quickly. We don't look like escaping this until someone comes in and says, we need more growth.
So here's the latest this morning in UK markets. Yields up, the pound nearing its worst week since 24. A potential challenge from Manchester Mayor Andy Burnham casting doubt on Prime Minister Keir Starmer's political future. Joining us now from Downing Street, Bloomberg's Lizzie Burden. Lizzie, just describe the characters involved and set the stage for the next couple of weeks in British politics.
Well, no formal challenge has been made yet, John, but Andy Burnham taking the first step to topple Keir Starmer here. He is known as the King of the North, very popular as Greater Manchester Mayor. He's Polymarket odds favourite to replace Starmer. He's the only senior UK politician who polls positively among voters, according to YouGov, a polling organisation. And yes, he's got past the first step. There is a seat opening up for him to stand in, but there are so many hurdles in the way. He's still got to be approved by Labour's National Executive Committee. He's got to win this by-election, and Reform are going to throw the kitchen sink at this election. It was a seat where they had the sixth highest vote share across the country back in 2024, but apparently Burnham wants to stand against Reform so that he can say, I beat Nigel Farage in a by-election, I can beat him in a general election. If he does manage to win the by-election, then he's got to have 81 Labour MPs back him in a leadership, to get to a leadership contest, and then he'd likely be standing against the former number 2, Angela Rayner, and maybe the former Health Secretary, Wes Streeting, although curiously, notably, in just the past few minutes, John, Wes Streeting has posted on X that Andy Burnham has the best chance of winning this by-election. We need our best players on the pitch. There's no doubt Andy Burnham is one of them. So keeping his cards close to his chest in the sense that he isn't challenging Starmer yet. He's actually backing Burnham in this by-election.
Lizzie, appreciate the update. Lizzie Burden there, covering the UK politics for us. You see it playing out pretty clearly in UK assets. The future is uncertain. It's unclear, Bramo, as to whether Andy Burnham even wins the by-election. There's a couple of hurdles to get through before we even talk about taking over from Keir Starmer.
That said, the longer this goes on, the more uncertainty there is around the fiscal backdrop of the UK, and that is not helping either the bond picture or, frankly, the currency.
Here's the take from Jayati Bharadwaj of TD Securities, writing the following. We expect the pound to remain under pressure versus the US dollar and the euro as political friction plays out in the UK. Jayati joins us now for more. Jayati, good morning.
Good morning.
What is specifically a UK problem right now? Because we see global bond yields rising, but in the UK much more so. What's specific about the UK issues?
As we were just discussing, it's clearly the political risk premium playing out in there, especially after Burnham yesterday, because there's a massive risk premium associated with him. He's clearly very popular, but he's popular because he's talking about a lot of fiscal easing policies. He talks about housing projects, infrastructure projects, social spending, public welfare programs. All of them cost money, which is something that gilt markets do not like, given that UK's debt to GDP is surprisingly very high for the economy. That usually raises concern if the UK can balloon up that deficit, given their potential growth is, let's say, lower than the US economy. So that is what's weighing on the pound and gilts right now.
How much is the U.S. unique in terms of avoiding this type of dynamic? We've seen sort of little signs around the margins that different types of policies could unleash this type of reaction. Do you see that in the cards in terms of some sort of Fed reaction to higher inflation leading to a response in the dollar?
So that's a very good question, because I think the U.S. up until, let's say, 2025, would not trade like an emerging market, which the UK is, which is where even if there were any fiscal concerns in the US, markets would just ignore it off, and then treasuries were a lot more resilient. Since the last 1.5 years, a lot of things have changed, and you have seen a little bit of signs of that emerging market trading behavior in the US and the US dollar as well, which is where around the one big beautiful bill, treasuries did start getting a little bit of concern. So that's something very different from the last year. Even right now in the conflict, you can see that the dollar is really struggling to rally. US treasuries, are selling off. There's so much inflation concern, but the broad dollar as a whole is really struggling to meaningfully rally and behave like the safe haven it was. Even if you go back to 2022, which is when we had the last big oil price shock, the dollar massively rallied in that year. If you look at how it is trading right now, it's very mediocre compared to that.
How much is this a story about policy, and how much is this a story about the debt overhang in developed markets that is dwarfing some emerging markets and leading, frankly, to a more haven-type trading in a number of emerging currencies versus the developed ones?
I think I wouldn't say that's the debt concern in the U.S. is not the main driver. I think the main driver has been that the U.S., instead of being shielded from the global shocks of the world, has now become the driving, emanating source of it, thanks to U.S. policy. There's so much uncertainty coming from the U.S. instead of the U.S. being shielded from the global shocks. I think that has led to a big perception shift around people just blindly pulling money into U.S. assets and then also doing it in the U.S. dollar. So we've seen marginal allocation of global wallets now go to equities outside the U.S., to global commodities. That's a big shift. And clearly the deficit profile, I think, has been marginal chips in the armor. You've not seen one big move in Treasury suddenly, but there's been clear chips in the U.S. armor over the last year and a half.
You're at no cuts for this year now, right, over at the Federal Reserve?
Yep.
That's a change from you guys.
Yes, that is true.
What changed?
Honestly, the incoming data in the U.S. has been more resilient. The labor market side of the story is staying stable. Unemployment rate stays stable. With that, inflation has clearly started surprising to the upside. The PPI report recently was a big surprise to the upside. And interestingly, while you're seeing that in energy as you should, some of the core services side also remain resilient. So that forms a picture where the Fed should not be in a hurry to ease interest rates again. Clearly, in the last Fed meeting, the bias had already started to shift because there was a hawkish dissent which had not been noted in quite some time. With the energy price shock and the fact that the U.S. economy remains resilient, the Fed should not be in a hurry to ease interest rates, which I'm sure will be a problem for Walsh, given the person who appointed him wants him to do.
You're not alone on that call either. That list is getting longer and longer. Jayati, it's good to see you. Thank you. Jayati Bharadwaj there of TD Securities. Coming up next, Alastair Pinder of HSBC, Henrietta Treyz of Veda Partners, Lorraine Hutchinson of Bank of America, Sébastien Rajappa of SocGen. The second hour of Bloomberg Surveillance just around the corner.
The labor market is still in this balanced environment, whereas inflation is moving away from the 2% target.
It's a pretty good economy, but that doesn't mean there's not tensions.
For the vast majority of this Federal Reserve, just doing nothing is tightening.
The case for a rate cut here gets tougher and tougher. There's a greater probability priced in of a hike.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your scores look like this. Here's the price action this Friday morning. We're negative by 0.8%. We've had quite a run. We were poised for a 7th consecutive weekly gain on the S&P 500. This morning, we take a bite out of that rally. On the Nasdaq, down by 1 full percentage point. Some of the nervousness in fixed income. Yields up across the curve. 2s north of 4%, 10s through 450. Your 10-year this morning up 5 basis points.
Yeah, Lori Calvasina of RBC Capital said earlier this morning that when we start getting to about 5%, all of a sudden it's risk off completely, and it really throws away some of the bull cases. That said, there's 1-2 punch here. On one hand, you've got inflation that seems to be resurgent around the world, yields going higher. On the other hand, people are getting a little nervous after the likes of NVIDIA rallied 20% in the past 7 trading sessions, adding $900 billion of value to their market capitalization. When they add a Berkshire Hathaway to their valuation in 7 trading days, people start to say maybe this is getting a little heady.
Catching a flight to China is worth $100 billion of market cap.
I mean, clearly.
More than $100 billion.
More. I mean, it's a pretty lucrative plane trip.
That's the tech move. We'll talk lots about that throughout this morning. Also, this bond move. The energy story, really hot PPI coming out of Japan, the leadership issues in the UK, the uncertainty, the lack of clarity around the reaction function of an incoming Fed chair. This is really important. Kevin Walsh is getting an early test from the bond market. The yield on the 2-year, just to isolate that point of the curve, trading above the policy rate of the Federal Reserve. Starting to think more and more about the risk, maybe not the base case, but the risk of a rate hike.
It is feasible to have an easing bias when you have disinflation. When you have reacceleration of inflation, it becomes a very different proposition. And reacceleration and inflation led by myriad different factors. This isn't just energy. When you strip out energy and food, you still see inflation running hot, tied in part to the hyperscaler spending and other materials and mining equipment. So you're looking at all of this and you're saying, what happens if the Fed doesn't hike rates? Well, that's the long end of the yield curve. And oh, by the way, this is global. As you've mentioned before, there aren't sort of the linchpins of Japanese bonds at 0% with them owning the market. You take a step back. We have ended the zero rate regime, and we are so far away from that. And how much are monetary policymakers prepared to enter a stagflationary type of feel?
Enter geopolitics. Let's talk about this. The president having a little gaggle on Air Force One right now, a conversation with reporters, getting more and more headlines from this. Lots on Taiwan. We'll spend some time on that. But this just crossed. On Iran, on enriched material. If we don't get the nuclear dust, we'll go in. The President of the United States just moments ago.
Yeah, one thing after another that's giving people the jitters that maybe the ceasefire is irrevocably broken, or at least that we seem to be entering a more fraught scenario. This also comes with the president saying that we don't need the Strait of Hormuz, also saying that they've been militarily defeated already, but still there's that issue of the Strait of Hormuz. Very mixed messages coming from the president. Either way, the bar for re-escalation seems to have gotten a lot lower, especially with the deliverables from this meeting in China.
Anne-Marie still in Beijing, in China. We'll catch up with her in about 10 minutes' time on those particular comments coming from the president. They continue. Those headlines keep dropping across the Bloomberg. Crude right now, Brent around 108, WTI around 103. Coming up this hour, we'll catch up with Alastair Pinder of HSBC, with stocks under pressure from higher bond yields. Henrietta Treyz of Veda Partners as President Donald Trump concludes his meetings in China, and Sébastien Rajappa of SocGen, with Kevin Walsh set to take over the top of the Fed. We begin this hour with stocks pulling back from record highs as bond yields push higher. Alastair Pinder of HSBC still bullish, writing, we revise our year-end price target on the S&P to 76.50 on, we've heard this so many times, earnings strength, but we could see it breaching 8K. Alastair joins us now for more. Alastair, good morning. Good to see you.
Thanks for having us.
Seen so many upgrades to price targets. Can you just take a step back before we get into all of the details? How stellar, impressive has this earnings season been?
It's been amazing. I mean, to put it into context, we're getting, 27% earnings growth for the S&P 500 this year. That's going to be its strongest, really, since post-COVID. The number of companies that are beating has also, basically been since post-COVID highs. And I think the really interesting aspect here, this is just not just a tech or a Mag 7 story. Strip out tech and Mag 7, you're still getting 13, 14% earnings growth from these companies. Again, very resilient, much higher than expectations. So it's the breadth of earnings which has been the most surprising to us. But again, what continues to drive the market higher here is the tech and the AI narrative.
There's a phrase that I'm going to borrow from a colleague of yours at HSBC, danger zone. Max
the danger zone, yeah.
Talks about the danger zone. Are we in the danger zone in the bond market?
We are. We're in the danger zone. And this is the trade-off now for markets, which is as soon as we get, the US 10-year bond yield pushing above 4.5%, the market's going to have to weigh the challenge between higher bond yields squeezing valuations and the earnings numbers, which have been so phenomenal. But it is a concern, and that is the downside risk here, that if we don't get oil coming down, if we don't see clear signs of de-escalation in the Middle East and progress towards opening the Strait of Hormuz, if this continues through June, July, the downside starts becoming more apparent for the S&P 500 here.
So just taking your advice, I'm looking right now at a 10-year yield of 4.53%, and I'm ready to hit sell. Why shouldn't I, right? I mean, if we're in the danger zone, why is that not the logical response?
I guess our view is that our base case is that there will be some normalization of the Strait of Hormuz in the next month or so. Our view is that oil will start to creep back down towards the end of the year, and that should start to put some of the pressure off bond yields. So, the base case here is that the market is already pricing in a pretty panicky kind of scenario, and we don't think we're there just yet. I think that, what makes us more concerned is, again, if this persists throughout the summer. And, from an economic perspective, a good way to frame it is that, US consumers have received almost $50 billion in tax refunds this year, more so than 2025. The cost of oil at $100 a barrel is $14 billion every month. So back of the envelope math is like, if we continue to get oil at 100 until June, July, that to me is when things start to turn a lot more negative. The impact on the US consumer, the impact on the US economy starts to turn more negative, and that's when we might see more serious earnings downgrades.
One of the biggest debates right now seems to be putting Paul Quincy versus Sébastien Page. Paul Quincy tried to diversify away from AI in different geographies, but also different types of companies. Seb really doubling down, saying ultimately he wants to get more into AI and more into the US specifically. Where do you sit on the whole diversification issue?
I mean, in a global context, we're overweight emerging markets and we're overweight the US, so we kind of like a bit of both. In the emerging market side, though, we're still playing, tech. We're overweight Taiwan. We're also overweight materials in LATAM, which benefit, by the way, from all of this AI capex spend, from higher copper demand, higher aluminium demand. So, I'm actually leaning into AI almost everywhere. I think what we are really focused on, though, in a global context is two things. One is AI adoption. I think that's how you diversify. Go into the banks, which are clearly using AI, seeing productivity benefits from this. And the other theme as well is trying to avoid these stocks which are going to be disrupted by AI. So again, some of these sectors like SaaS, et cetera, where we think there's going to be an overhang, whether it's true or not, I think it's hard to disprove in this current environment, but we want to avoid the areas which we think there's going to be fears around disruption. So in the kind of diversification perspective, I'm fine diversifying out of the tech, but when we go into the, ex-tech names, I still want to be looking into the areas that get the biggest, productivity gains from AI adoption.
When I hear EM, I always smile, because it doesn't mean what it used to mean. It's now 2 countries, 3 names making up a quarter of the index. The MSCI EM index. Taiwan Semiconductors, 14%, a little bit more than that. Samsung is about 6% of the index. SK Hynix is a little more than 4% of the index. We're reducing things down to just a handful of names. I just got this note from CIBC, Chris Harvey. I'm sure you know him. Chris said this: by our calculation, this is SPX. SPX attribution. Tech and communication services have accounted for 90% of the returns of SPX since the end of Jan until yesterday. On an individual basis, 9 names accounted for roughly 90% of the return over that period until yesterday, with NVIDIA responsible for 20 to 25% of the overall return. Do you think that's a problem? Is that necessarily a problem?
I mean, I do laugh about this conversation about concentration, because everyone says it's a risk. I'm like, well, it's a risk in both ways, downside and upside. If you think that this concentration, the names that are driving, the upside here are going to continue to outperform, that's great. And so you take the EM story, and it's kind of funny because you're saying that, EM is not what it used to be. I would disagree a little bit. What was EM in 2000 to 2010? It was a commodity cycle. Well, DRAM and semiconductors are the commodity of the AI era.
Smart.
So is it not just that we're in a different kind of commodity play here for emerging markets? And I'm totally bullish on that. And so I'm totally leaning into this. If I think there's going to be more capex from the hyperscalers, $150 billion in capex estimates just being added for 2027 and 2028, 20% of that goes to the Korean memory names. I'm leaning into this. So I don't have any issue, particularly when, the Korean stocks and the Korean memory names trade on 6 times earnings. To me, it feels like a bit of a no-brainer to go into that.
As prices go up of those commodities, those new commodities, how elastic is that demand for these particular goods?
It's completely priced inelastic. I mean, you're seeing, the memory names basically saying they're entering into 3 to 5 year long-term agreements with the hyperscalers because there's so much demand for it right now. And why that's so important is because it reduces the price volatility, and it gives us much more earnings visibility than we've ever had before. 3 to 5 years of the big hyperscalers saying, hey, we're going to take out all of your supply. To me, that is a very bullish narrative here.
Alastair, good to see you. Appreciate the framing. Interesting stuff. Great response. Alastair Pinder there of HSBC on the insatiable demand for some of these goods in tech right now.
And we've seen it in terms of pricing power. I mean, just how elastic is it? Pretty inelastic, it seems like. And they're being given a long rope when it comes to debt investors that are investing in some of these issues. I think one of the skepticisms here is we don't know what we're building toward. We don't know the end point. When is it going to be enough AI? When are we going to reach some sort of equilibrium where things stop moving at such a rapid pace and we have to keep spending this much on infrastructure? That's one overhang, I think, that's leading to a little bit of anxiety.
From capacity constrained to over-constrained, and that's the bust, right? That's the overcapacity, that's the bust.
Yeah, or just what does the world look like? I mean, not to go all existential, but these are the questions that a lot of people say. What is the ultimate existence of humans in this AI world? I know this sounds science fiction. No, but this is actually, I mean, I don't mean in a negative way. I mean, truly, where do they fit in the world that's controlled by,
robots and AI. On the Nasdaq right now, down by 1.2% on the Nasdaq 100. It was going so well. On the S&P 500, down by 0.9, with an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. An Indian-flagged ship sinking in the Strait of Hormuz this week after coming under attack near the coast of Oman. The Wall Street Journal reporting India's foreign ministry says Omani authorities rescued all the crew after the attack without saying who was behind it. The U.S. House narrowly rejecting an effort to stop the war in Iran and remove U.S. troops from the region. President Trump saying hostilities officially ended at the 60-day mark, a declaration that could help the administration avoid seeking congressional approval for its operation. And U.S. Trade Representative Jamieson Greer expects the U.S. and China to restore ties for agricultural products. Greer telling our own Annmarie Hordern in Beijing that a new trade deal could open the door for U.S. businesses.
And we expect to also see an agreement for double-digit billion purchases of ags over the next 3 years per year coming out of this visit. And that's more general. That's aggregate. That's not just soybeans. That's everything else.
Greer also confirming the two countries will establish a board of trade to oversee a cut down on $30 billion worth of tariffs on goods. That's your Bloomberg brief, John.
Yahira, thank you. Thanks for the update. Up next on the program, tariffs on the back burner.
President Xi's an incredible guy. Got along, made a lot of great trade deals. They're paying tariffs. They're paying substantial tariffs, but we didn't discuss it.
Up next, we'll catch up with Annmarie, plus Henrietta Treyz of Veda Partners from New York City this morning. Good morning. Just a bit softer here. We're down by 0.9 on the S&P 500. On the Nasdaq 100, down by 1.25. Record highs coming into Friday, heading towards a decent, robust week of gains. But running into this in the bond market. 2s, 10s, 30s, yields creeping higher. Stateside up by 5 basis points on 10s through 450, approaching 5.1 on a 30-year. Jitters in the UK around the leadership race, much bigger moves there, but also big moves in Japan as well. The backdrop globally, if all these countries have got anything in common right now, it's higher energy prices and limited fiscal space.
Yeah, right now it seems like when people see higher PPI prices and significantly higher, I think it's fair to say these are huge beats when it comes to some of the inflation rates in the United States and over in Japan. People are saying, what's the offset to this? Probably there will be the desire to have more fiscal spending, even though there isn't necessarily the headroom for it.
Elsewhere, the summit wrapping up between the US leader and the Chinese leader. The President Donald Trump making his way back to the US on Air Force One, engaging with reporters just moments ago. Check out some of these comments. Under surveillance this morning, tariffs on the back burner.
President Xi's an incredible guy. Got along, made a lot of great trade deals, including over 200 planes for Boeing with a promise of 750 planes. We didn't discuss tariffs. I mean, they're paying tariffs. They're paying substantial tariffs, but we didn't discuss it.
So here's the latest this morning. Tariffs failing to make the agenda during a summit between President Donald Trump and Chinese leader Xi Jinping. President Trump offering more details of the talks as he returns to Washington from Beijing. Annmarie has more. Annmarie, some intriguing comments on a range of issues. Let's start with Taiwan. What did you make of what the president had to say in the last hour?
Well, the president definitely wanted to make sure he was socializing the issue of Taiwan in a very delicate manner, but he really pulled back the curtain and brought reporters into the discussions. He said that, of course, it came up. He was asked about the 6 assurances from President Ronald Reagan in 1982 that you would not consult China in regards to arms sales to Taiwan. He said, 1982 was a long way away. She wanted to talk about what am I supposed to do? Not engage. And he said, though, when he was asked, would the United States defend Taiwan? And he said he's the only person meeting him, President Donald Trump, that knows that. And he said he was asked about it today as well by Xi Jinping. Xi Jinping asked him, would you defend Taiwan? And he said he will, in the coming days, make a decision about the arms sales, that $14 billion package that's been in the docket that was not approved before this trip. He said he'll be making that decision in the coming days. So that is something we should be on the lookout for. But he said, who wants a war right now, 9,500 miles away?
Annmarie, the Chinese leader is a dictator. The US leader is accountable to the electorate in the US and in Washington, D.C. I imagine there's members of Congress who have their own thoughts about what should happen here. What is the president going to arrive back to in Washington, given this exchange?
Well, Jonathan, before the president left Washington for this trip, he got a letter from a number of senators, Democrats and Republicans, that wanted him to move ahead quickly on the $14 billion package that's waiting in the wings when it comes to the arms sale to Taiwan. We should note it is not unprecedented for former presidents as well to not immediately clear an arms package ahead of a big trip with the Chinese leader. You don't want to really mess with the imbalance of how this trip, potentially some of the deliverables you want to get out of this trip. It's a very sensitive, delicate issue. So that is not unprecedented. What is going to be interesting, as you note, is what kind of pressure the president gets when he lands in Washington, D.C., based off this exchange, given the fact that clearly Xi Jinping made Taiwan their red line. I go back to what happened yesterday. The meeting wasn't even over. And what we had from the Chinese readout was that Taiwan needs to be handled appropriately. And if mishandled, that could lead to conflict and a dangerous situation between Washington and Beijing.
Annmarie with the latest in Beijing. Annmarie, thanks for your work over the past week or so. Just fantastic. Henrietta Treyz of Veda Partners joins us around the table here in New York. Henrietta, good morning.
Great to be here, guys.
How does Congress respond to what we've just heard?
Congress is not going to take this happily. There are so many more China hawks that still exist in both the House and the Senate side. And their first reaction to this China summit is going to be, why are we talking about Taiwan? We should be talking about soybeans. We should be talking about investments. There are tariffs across $350 billion worth of goods. And instead, we're talking about arms sales to Taiwan, which is very much China leading the direction of the conversation, leading this overall meeting. And that's going to be the core takeaway for members.
What do you make of the trade agreements that were reached in terms of the 200 Boeing planes versus the initially believed 500 planes and some of the agricultural purchases? How are those stacking up in the United States?
Well, I really want to see the details on the soybean side. I think it's really critical, especially for farmers who saw a 46% increase in bankruptcies in 2025, that they have, under President Trump, from his first term to his second term, seen major shifts in soy purchases. China has cut us off. The deal that Ambassador Lighthizer reached in 2020, when they had their first major trade agreement, was for 142 million tons of soy over 2 years. The deal that Secretary Bessent reached last year was for 87 million tons of soy over 4 years. That's a 69% drop. And now here we don't have any details of any soy purchases. The farmers are in a bad way, and that's a problem for Republicans across the board.
The message coming out of these meetings is that the priority is some of these purchase agreements, right? That the idea is to get engines and to get planes and to get soybeans. It isn't necessarily on having a hard stance with Taiwan, staking a geopolitical place in the world versus China. Is that where things are shifting among the populace in the United States?
I'm glad you asked. I look at this data all the time to see if there's a chance that Americans care about foreign policy. It does not register on Americans' radar. They care about inflation, prices, the economy, and then way down at like 11th, anything foreign policy related. They do not concern themselves with Taiwan. That is a core issue, as you point out, John, with the members of Congress and China hawks and defense hawks, but it doesn't register on an American public that feels very pessimistic about their finances, about their job prospects, and is overall anxious.
Local issues. I see this play out in the UK as well. When you see particular leaders talk about these big global issues, foreign leaders talking about the US leader, I don't think in the UK, for instance, UK is a great example of this, by the way, when you start moaning about what's happening abroad and the mistakes other leaders are making internationally, people feel ignored at home because they want their local issues taken care of. Are we going to take care of those issues going into the midterm? Are we going to see more specificities when it comes to those kind of things?
I think it's important to look at the bills that are being introduced, as you point out, and I think there's two that I would highlight for the average American. One is, how long is this war going to go on? How long are gas prices going to be so elevated? And there is a war powers resolution that allows the president to perpetuate the war through September 1st. That is the shortest duration authorization of military force that I've seen. There's other proposals out there for 12 months. And then the second piece is the gas tax holiday. And the gas tax holiday does not have enough support to pass, but it's informative to look at the dates associated with it and how long lawmakers think that gas prices are going to be high for. The bill that was introduced this week by a Republican in the House lasts through December 15th. They are expecting this to go on for a long while.
This is the federal gas holiday. What are they doing at the state level to achieve something similar?
Different states are doing different things, and in some cases they have a higher gas tax, so it's helpful. Georgia, for instance, has a 33-cent gas tax. They've already suspended theirs. Oftentimes states are doing 30, 60, 90-day suspensions, but the federal level, the votes aren't there at the federal level, so the president would have to act the executive order, which most other administrations have determined they cannot.
Just to bring it full circle, at what point does Taiwan become a local issue when it has to do with chips? I mean, it's one thing to say this is just a geopolitical issue. It's another thing when suddenly this becomes a massive market issue and, frankly, every electronic product issue that everybody has in this country. At what point is that connection drawn?
Well, I mean, I think the PPI data really tells you that there's going to be those costs that cycle through, and whether it's the Strait or whether it's Taiwan, that's in your refrigerator, that's in your telephone. You're going to need to buy all those things, and costs for there from PPI data being released, it's a 60 to 90-day lag before it starts hitting consumers. So it's coming for the American public. Maybe they won't recognize that it's due to Taiwan or maybe even the Strait, but they'll feel the pain, and it'll continue to register in the inflation data.
Henrietta, it's good to see you, as always. Thank you. Henrietta Treyz of Veda Partners. I'm sure they're able to draw the dots. It's pretty obvious. The question they're asking is, why are you there? And convincing the American public that you should be there is the hardest task right now.
Especially because our reserves are down, right? I mean, how much have the munitions been depleted as a result of some of what's been going on in Iran? Questions of different troops that have been deployed for months and months and months on the sea. Where is the willingness, especially with the cost already rising for that military incursion? Again, questions that people want to know. How much did Xi Jinping take advantage of that fact?
It gets difficult to offset that at the federal level, not just in the US, but in places like the UK, across Europe, in Germany, to issue more debt when you see the pushback coming from the debt market at the same time. It's almost like a perfect storm right now in fixed income, pushing back.
Well, Torsten Slok made this point yesterday. I thought it was really important, which is if there is another economic downturn, where is the ammunition going to come from on the fiscal side? And how much are bonds going to act as a haven as they have in the past if there is this push-pull between fiscal stimulus, inflation, and so much debt sloshing around?
Well, thank goodness we're done with the hantavirus now, right?
Well,
we're done with that. We've moved on.
We have, although there was a story about how just natural sickness is actually on the rise. Okay,
but we don't have to shut down the economy.
No, good. We're good. No hanta.
Lorraine Hutchinson of Bank of America up next. Equity futures right now pulling back from all-time highs. We're down by 0.9% on the S&P. Coming into Friday, as of Thursday at the close, up for a 7th consecutive week. The longest weekly winning streak going back to December 2023. Will we undo that, upend it with these moves? We'll see. But we're taking a bite out of that move so far. We're down by 1.3% on the Nasdaq 100. Driven by these moves in fixed income, yields higher, stateside and worldwide, on 10s right now through 450. Of 5 basis points on the session, near the highs of the year on 10s and 30s, and worldwide, levels we haven't seen in decades over in Japan.
Unclear exactly what the lever is going to be for monetary policymakers to constrain this. You've seen the Bank of Japan refrain from hiking rates again, even though people expected them to do so. And here in the United States, there's an expectation that the new Fed chair, who is going to come in possibly next week after today being the last day of Jerome Powell's term, coming in will not have the desire to hike rates either, despite what we're seeing in the bond markets. These two factors really adding to the mood in markets.
Can we bring up the US curve again and just think about where we are right now? So twos, as we we've stated repeatedly through the week, trading above where the policy rate is at the Federal Reserve. This is going to be a really interesting moment for the incoming Fed Chair, Kevin Walsh. What does he choose to prioritise? If he tries to clarify his reaction function and anchor the front end of the curve closer to where the policy rate is, where does that leave 10s and 30s? And how vague is he going to be about what he wants to achieve with the balance sheet at the same time? So we talked about this repeatedly too, that every central bank chief gets their test in the market. Always happened to Powell, happened to Yellen, seen it abroad, happened to Lagarde. Is that moment starting to build for Walsh very early on, before he even gets in the seat?
He comes into a fraught moment where suddenly the dual mandate of the Federal Reserve is very much potentially in conflict, although people are saying they're seeing green shoots in the labor market. And this is someone who has traditionally been a hawk. I think it is important to reiterate that. So his reaction function has actually been to hike rates in the past. How much has that changed in the Trump era?
10's up 5 basis points, 4.53 this morning, 2 hours away from the cash open, the opening bell just around the corner. Danny Berger has your morning movers. Hey, Danny.
Hey, John. Some of those higher bond yields are taking some of the air out of the hottest trades. The hottest trade, of course, being a lot of the chips and semis on that record run. So a few things going on, that being one of them, too. Cerebras, we got this blockbuster IPO yesterday. It rallied 68%. It's down just about 1%, so not nearly enough to undo the huge rally. But again, a lot of optimism. Some of that comes out. We also end the U.S.-China trip without any meaningful deals around chips, around NVIDIA, for example. So most of the sector down this morning. Intel getting hit the hardest, down 4.3%. Elsewhere this morning, Figma reporting earnings, and shares are up nearly 11%. It's all about their AI-driven offerings. They have Figma Make, a tool that enterprises can use, and they did cite a lot of large enterprise adoption, so positivity there, up 10.5%. Elsewhere in earnings, Gemini, the Winklevoss twins, crypto exchange, also reported earnings. It's rallying a lot, not necessarily on the numbers, but a strategic investment from the twins themselves, $100 million at $14 a share, so significantly higher than where they're trading. Evercore points out that were it not for that, shares would likely be lower because the earnings missed on a lot of key metrics, but those shares up 20.5% in the pre-market, John.
Danny, thank you. Appreciate it. Do you remember the whip around over at Blackstone?
Oh, yeah.
That came up with all that money? That's the whip around over at Gemini. It's not bad, is it? Some deep pockets there.
I mean, when you start thinking about some of these founders, I mean, wasn't it the founder of Cerebras now is a $3 billion man overnight? Yeah. It's sort of, other worlds.
It's pretty impressive. Not our world. Pretty impressive, nevertheless. On our radar this morning, President Donald Trump offering more details of talks with his Chinese counterpart Xi Jinping. The president telling reporters on Air Force One just moments ago he's made no commitment over Taiwan and would make a decision over arms sales soon. Controversial. Elsewhere, OpenAI CFO Sarah Fryer telling us here at Bloomberg the company may need to raise more capital to meet surging AI demand.
We have seen an incredible lift in our revenues to match just the demand that I'm talking about. On top of that, we have raised a lot of money. I'm not averse to raising more capital, although right now that $122 billion gives us a lot of optionality.
Fryer adding that future fundraising will depend on the gap between computing power needs and what OpenAI can afford. And finally, Bramo mentioned it, Cerebras Systems soaring more than 68% in its highly anticipated public debut. It's the largest IPO so far this year, as appetite for AI data centres and the chips running them continue to grow. That stock down just marginally this morning by 1.6%.
Yeah, but as you were noting, the best debut of its kind in decades. And what we're seeing right now in markets is a really warm reception for a chip maker. And this is the key. It's a chip maker. This is not OpenAI. This is not Anthropic. This isn't SpaceX, although it potentially sets the stage for a really profitable moment for them as well later this year when they IPO. Nonetheless, they sit at the epicenter of the spending boom from the hyperscalers. They make a different kind of chip than CPU or GPU. I was looking at its clients. Guess who's in there? Yes, Amazon Web Services, but also OpenAI. So how much are these all integrated as well and relying on one another to continue to profit as they build out the AI?
In one word, very. We'll talk about the K-shaped consumer in a moment. The K-shaped market as well. There are companies that have access to the market right now, both public and private, that can raise tons of money, can come to an IPO, come public and have a move like that on its debut. Alphabet can tap the bond market here, there and everywhere, met with fantastic demand. I just wonder how bifurcated that is. The AI ecosystem, so to speak, and then everybody else.
Well, you've seen that with some of the potential losers from AI, with the SaaScopolis, or this software as a service that potentially gets undermined as a result of people using AI to build their own rather than to buy their own. So going forward, this is going to be the debate. How much dispersion should there be? Who are the winners in the AI sphere going to be? And will the appetite remain for all of the other much, much bigger IPOs, it should be said, that are on the schedule for later this year?
That's the K-shaped market. Let's talk about the K-shaped economy. Turning to retail, investors are waiting earnings next week for another reading on consumer spending. Lorraine Hutchinson of Bank of America writing, we expect TJX, Ross and Burlington to speak to a strong start to the year, supported by elevated tax refunds and trade down driven by gas inflation. Lorraine joins us now for more. Lorraine, good morning.
Hi, good morning.
It's good to see you. How squeezed are consumers right now?
Not as squeezed as I think people fear. And remember, we're getting first quarter earnings, so it's a little bit of a backward-looking data point. But consumers were receiving very high levels of tax refunds throughout the first quarter. So that served to more than offset any squeeze they felt from gasoline. I think what's really important, and brace yourselves for a big week next week, the forward outlook is, as these tailwinds wane, what happens? Because gas prices are still very high.
What do you think happens?
The wallet. I think that the consumer takes a little bit of a decelerating trend. I think they trade down. I think they use their dollars a little more wisely, and they really search for value.
TJX, the last time they had a down year, I think you've got to go back to, 2008? Something like that. They've had a fantastic run.
I didn't say TJX would be down.
No, I'm going to say, are they going to have another up year?
No, I think absolutely not. And when you look at, we've gone back 20 years and looked at times when gas prices spiked. And you look at clothing spending, it falls. Jewelry spending, it falls. Off-price retail behaves much more like a necessity and goes at its normal trajectory. And the reason is their customer may have to trade down, and then an upper income customer trades down into their stores looking for that value, right? Everybody's wallets are squeezed. They end up taking share.
How much are we seeing a K-shaped retail sector? And it doesn't have to do with necessarily the income strata of the clients as much as the success of management teams to really put forward a story that either works or really doesn't.
Yeah, I mean, what we've seen in a time of a little bit of consumer duress over the past year or so is that if your brand is hot, you are really able to get that share of wallet. Coach, the Coach brand is a great example of that. Right? They just put up a 29% growth rate in North America. I don't think any of us would have expected that a few years ago, but they made some great investments in marketing. They've really elevated their brand, and they've been successful. You can contrast that with a lot of other players, both in the handbag and footwear space. They're not seeing the same success.
Well, I'm going to talk about Nike and Lululemon, for example, which have been underperforming, and we've talked about it a lot on the show. John's been talking about Nike and how they really lost some of their vigor of the athletic heartbeat that they used to be driven by. Going forward, how much can we look at earnings as giving a read on the consumer versus a read on strategy, given the results that we've had so far and given the consumer spending numbers that we've seen from some of the big cards?
Yeah, the results have been so bifurcated, right? You'll see retailer, even footwear retailers like On Holdings or Hoka putting up growth, and then you see Nike putting up declines. So it's really a big share shift, and I wouldn't use Nike as a gauge for the consumer. Nike just didn't innovate like it needed to, and when you have competition nipping at your heels, you really need good product. They relied on some of their old stalwarts instead of really going out and doing what Nike usually does, which is lead the market with innovation.
You don't want to be apologising. I just feel like Nike as a brand has completely lost its attitude. And we were talking in the commercial break before we came on about the Boston Marathon and that commercial they had, walking tolerated, right? Old school Nike sort of get at it, do it, get aggressive. And then they were apologising for the walking tolerated. People were offended. They pulled the ad and went with something else. That's kind of where Nike's at today. That is not what Nike used to be. What changed at that company?
Look, they're much bigger, and they now target not just runners, but walkers. And I think they need to remember that. So what changed? They've had a few different management teams come in. And again, I think they lost their focus a little bit on sport. They got into a lot more casual, a lifestyle product, and now they're actually completely refocused on performance product. It will take more time because that's a smaller part of the market, but I think it is the right strategy for them.
From a branding perspective, who's got it right now? We mentioned American Eagle, sort of unapologetic, offended some people, did not apologize, sales went up. Who's got it right at the moment?
You know, I think there are several brands. Ralph Lauren, Coach, is certainly having a bit of a moment. Birkenstock put up really strong growth earlier this week. So there are some brands that are doing quite well. The Gap brand is showing a resurgence that I certainly hadn't predicted, but it's been really fun to watch. So yeah, there are several of them with great marketing and good product, and they're kind of coming back from where they used to be.
I think about the Gap CEO, Bramo, you talk to him a lot. He just sort of personifies the brand. Whenever he walks into the room, whenever he sits alongside us, he's like, that is the Gap.
Also, he had this to say about American Eagle. He said that you shouldn't shy away from controversy. You should meet the cultural moment. And he is a big believer in telling a story using cat's eye with dances and denim and trying to meet sort of the cultural ideas of the time. You have to kind of lean in at a time where increasingly it's storytelling beyond everything else. It has to be delivered in sort of viral memes versus some sort of billboard that delivers a message that you have to adhere to.
Nike just seems scared, and that's not what that brand used to be.
You know, ultimately, it does come down to how do you compete and how do you be edgy. Right now, I was seeing New Balance trying to be edgy when I walked into a store, and I was thinking to myself,
it's crazy what that was to us as kids, right?
I mean, you think about, Dad, your sneakers are over here.
30 years ago.
I know, and now they're like platform sneakers with new colors and, get yours today.
Lorraine, it's good to see you. Thanks for being here. Thank you. Lorraine Hutchinson there of Bank of America. I was thinking the same thing, New Balance, honestly. They were the things that were on sale. You'd never get me a New Balance as a kid.
I went into a Foot Locker recently with a child who needed new shoes desperately. And there were shoes that looked like moon boots. And there were things that were like, 5 feet tall. And they looked like, Tesla trucks and, whatever. People at least are trying new things. And then you saw Nike, and it was just sort of sitting there in the corner. It's sort of, how do you get your brand out there in your face, even if it isn't the most attractive to everyone?
Like a World Cup coming up as well. Usually they've selected the player with the biggest attitude, a ton of flair, they get behind them. I don't see any of that happening with that brand right now.
Maybe they're filming it. Maybe I'm part of it.
Okay,
you just don't know.
The clock is ticking. I hope you are. I look forward to that. All right.
Nobody needs that.
Let's get you an update on stories worldwide with your Bloomberg brief. Yahara has more. Hey, Yahara.
Hi, John. President Trump speaking to reporters on Air Force One as he returns to the U.S. from China. Trump discussing his talks with Xi that covered the war in Iran, as well as the situation with Taiwan.
On Iran, it's very interesting. He feels strongly they can't have a nuclear weapon. He wants them to open up the strait. On Taiwan, he does not want to see a fight for independence because that would be a very strong confrontation.
Trump going on to say he will make a decision about arms sales to Taiwan soon. Cuba has run out of the fuel oil it needs to keep its power plants running. President Miguel Diaz-Canel blames President Donald Trump, posting on X that the dramatic decline in conditions is due to what he calls the genocidal U.S. energy blockade. And LVMH is selling the Marc Jacobs brand to a venture between WHP Global and G3 Apparel Group. The deal coming as LVMH looks to capitalize on its higher-end luxury brands, including Louis Vuitton and Christian Dior. A lot of letters there. That's your Bloomberg brief, John.
Hey, Yahara, thank you. Appreciate it. Thank you very much. Up next, hoping for a transitory transition.
Transitions are important, and I think that, it is maybe helpful to have someone there to give advice, but I still think it's important that it be a transition because you want to have there be very clearly one chairman.
Up next, we'll catch up with Sébastien Rajappa of SocGen, live from New York City. This is Bloomberg Surveillance. Stocks just off session lows, down 1% on the S&P 500. Negative across the board here. On the Nasdaq 100, we're down by 1.4. Welcome to the Federal Reserve, Kevin Walsh. Check it out. In the bond market, 2s, 10s, 30s, 2s north of 4%. That was a bit of a ceiling for this bond market for a while. We've broken through it. up by 3 basis points today at the front end of the curve, up by 5 to 6 at the longer end of the curve. The 30-year yield just feels a little bit untethered at the moment. 5.1% on 30s this morning.
Unclear exactly what's going to pull it into check, and ultimately it comes down to who is Kevin Warsh, what's his reaction function going to be, will he be willing to hike rates in the face of inflation that seems to be reaccelerating?
Day one on the job, under surveillance this morning, hoping for a transitory transition.
Transitions are important, and I think that, it is maybe helpful to have someone there to give advice, but I still think it's important that it be a transition because you want to have people's loyalties undivided. You want to have there be very clearly one chairman. You want to have a place where there's no question about who's in charge, and there's no talk of rival factions and things being split.
So here's the latest this morning. Jay Powell's term at the top of the Federal Reserve coming to a close, opening the door to incoming Fed Chair Kevin Warsh. Rajappa of SocGen writing the US economy remains resilient despite higher inflation, which should keep the Fed on hold for the remainder of the year and possibly even longer. Sébastien joins us now for more. Sébastien, good morning.
Good morning.
To see you. We've talked about this repeatedly this morning. The market often tests a new leader. Is that test beginning a little bit earlier?
Absolutely. I think the bond market's not only just testing the Fed leadership, it's also putting Congress on notice because you're starting to be concerned about higher debt and deficits, which I think is what's playing out in the very long end. In the very front end, the market's starting to price in hikes. What is really, really going to be important for Kevin Warsh is keeping inflation expectations in check. When inflation expectations start to get a bit unhinged, then he has a problem in his hands. So I think, it's very, very important for the Fed to change its bias from easing to neutral and be ready to act if needed.
So in June, that's the opportunity to do that. They also have to put out forecasts. So just describe, and I know it's early, and June even now, we're sort of mid-May, June feels ages away. But when we get to that meeting, what's that SCP going to look like?
It's going to be very interesting. I don't see how the regional Fed presidents change their forecasts meaningfully. If anything, they're going to continue to show a bias towards higher inflation. I think the labor market's still relatively stable. So you're not going to see perhaps a significant rise in the unemployment rate. Growth is going to be interesting. Last time I was expecting maybe they'll start showing, concerns that growth might start to trend lower. That didn't really happen. If anything, you're seeing significant amount of investment in CapEx coming from the hyperscalers for not just this year, but for the next several years. That's continuing to support growth in the U.S.
Would you rather buy at the front end with the belief that the Fed is not going to hike rates no matter what, or the long end, believing that this Fed is more likely to hike rates than a lot of people think?
If I had to make a choice, I would say the front end, but I'm starting to get a bit concerned because bond yields definitely feel like they're getting a bit unhinged. I think we should be really paying attention to the signal that we're getting from the bond market because the bond market's actually starting to say, pay attention to all the dynamics that are happening. Higher oil prices, the potential impact of debt and deficits, not just in the U.S., but globally, and then the overall, picture of this war is not getting resolved anytime soon. The presumption in the markets was that we get through, it'll be a short conflict, and then oil prices start to trend lower. But the longer this drags on and the longer oil prices remain high, I think that really sends a very strong message for both Congress as well as, the Fed chair to be much more vigilant.
Can this message be dampened by a Fed Treasury accord?
I think it's too soon for that accord to be put in place. I mean, I think it's going to take months to come up with some sort of a framework that makes sense to be able to deal with this issue. I mean, as it stands, the Fed is somewhat working with the Treasury in the sense that the Treasury is issuing a lot more bills. The Fed is buying more bills and trying to reduce the average maturity of its SOMA portfolio. I'm not sure what else they can do over the near term on that front.
That's the challenge. You can't play the same hand twice. My memory's a bit hazy, but it was at the back end of 23 when we saw the changes from Janet Yellen at the Treasury to move the issuance.
Yep.
And ultimately, the corrective action from the Treasury helped yields to top and then to decline. Mm-hmm. You can't do that a second time. So what kind of corrective action could we see from the Treasury in response to this kind of thing?
Not really a whole lot. I mean, I think what you really need happening is on the policy front. The Fed's going to have to show some sort of a bias to hike if we see inflation expectations getting unhinged. And more importantly, it's going to be on the trajectory for debt and deficits. To me, that's an under-discussed topic. If you look at the Trump administration's ask on what they want for fiscal year 2027 for defense spending, you're looking at the defense spending going from close to $1 trillion to $1.5 trillion. Extrapolated over the next 10 years, you get some really, really big numbers for debt and deficits. On the other side, there's just no willingness to address that issue. There's not going to be any near-term increases in taxes. We're not going to be able to grow our way out of it. So it's just going to continue to get worse. And the longer interest rates remain high, your debt financing costs go higher. So that's what I'm really concerned about.
You've alluded to this a few times now, so can I sort of spell it out? Do you believe the best way to keep long-end yields anchored is to threaten to hike front-end rates?
Yeah.
Do you think that's an understanding that's shared on the committee?
You mean the FOMC?
Do you think they get that?
I think that there are some hawkish members in the committee. We saw the dissents at the last meeting. They clearly want to change the bias. They want to be prepared to hike if needed. The question is whether the chair and the doves in the committee get the same message.
How many doves are left, just out of interest? How much company is Kevin Walsh going to have? If Kevin Walsh is indeed a dove, because we really don't know that until we hear from him in the seat at the Federal Reserve in the news conference. How much company's he got?
We know that a few of the governors, Waller, as well as Michelle Bowman, maybe Powell, are on the same page. Regional Fed presidents are starting to fray. You do have people like Mary Daly, who's a bit more on the dovish side. But broadly speaking, I think the consensus is starting to slowly move towards at least a neutral stance on policy.
Some real pushback from Michael Barr in the last 24 hours as well. Pretty explicit about what he thinks the major risk is here.
Yeah, and he's just one of a number. We've heard, of course, from the Minneapolis Fed president, from the Boston Fed president, from Kansas City Fed president, Eric Schmidt, who said that he saw continued inflation as the most pressing risk to the economy. So it doesn't seem like this is a Fed that can remain an easing bias. Do they understand that they need to actually adopt a hiking bias in order to tame the long end of the yield curve? June's going to be an interesting one.
I'm just envisioning that June meeting and TK around the table with us saying OBE, overtaken by events, and that event right now, if it was today, would be in the bond market.
Yeah, and then the counter event will be in the Truth Social market. So again, this is the conflicting issue. Are markets conflicting right now? Because at the front of the yield curve, there is a real belief in a hiking bias at the Federal Reserve. Is that adopted by equity markets? Have they adopted a real hiking bias in terms of their understanding of rates?
Sabadra, it's good to see you. Thanks for being here.
Good to see you
Sabadra Rajappa there of SocGen. Coming up, Ulrike Hoffmann-Burchardi of UBS, Tom Mortonson of Baird, Erin McLaughlin of the Conference Board, plus Scott Cronin of Citi. The third hour of Bloomberg Surveillance just around the corner.
What you have right now is an earnings-driven market.
People want to get exposure to growth and strong economy earnings go ahead.
Earnings momentum doesn't seem like it's peaking.
If you think of what's driving these global markets right now, it's a semiconductor super cycle for the history books.
It's the casting away of fear in its entirety that will end up being the market's biggest problem at some point.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores, the price action looks like this, pulling back from all-time highs. We're negative across the board. We're down 1% on the S&P, down by 1.5 on the Nasdaq. With these moves in the bond market, some new numbers for you, north of 450 on 10s, up by 6 basis points, and 90 minutes out from the cash open in equities, yields making new highs for the session on 30s, pushing 5.1%.
People are getting a little bit more concerned as they see a yield curve steepening on the margin, even as we're pricing in rate hikes, at least in the margin, by April of next year. That's according to the 2-year yield being above the Fed funds rate currently. You start looking at this, what is it portraying? A bit of unmoored inflation. We're getting that hotter than expected PPI prints around the world, and a lack of monetary policy response to offset any kind of inflationary pressure. And it's not just who the new Fed chair is, but it is a global issue. There is a desire not to stymie any kind of economic growth, even amid inflationary shock after inflationary shock.
Look at the issues globally right now. Leadership issues in the UK, PPI, the hottest in 12 years. Over in Japan, deficit problems there. The lack of fiscal space across the continent in places like Europe. Then in the US, right now in the US, allflation and no stack. So you're not even having growth get hit, which might support the bond market. You're getting hot reads on CPI, on PPI, and the economy right now is pretty resilient. So the bond market's going to keep pushing and keep pushing and keep pushing. And at some point, the test arrives at a doorstep of Chairman Walsh. And I think that test has come a lot earlier than expected.
Yeah, in June, they're going to have to really move either to a neutral bias or even a hiking bias in order to meet the moment that we're seeing expressed in markets. If they maintain their easing bias, that would be a shock. If you take a step back, there is a sea change underway. You were talking about when you and I used to talk about the linchpins of the bond market, negative yields around the world, Japan not moving, them owning their bond market. We're now at a phase where we've seen decades of financialization of markets, and now we're going back to industrialization. We got to pay for that. And we're seeing bond sales up the wazoo to try to pay for that. And all of a sudden, all of that capital that people have had has to go to work. And that is a new regime, and suddenly you got to pay up for that money. So there is a structural overlay that also leads this to be a higher yield environment in a more natural way.
It was a different world. There was a lot of stock buybacks, plenty of capital returns, not much capex, driven by the biggest companies on the planet doing something very, very different. Now it's changed. Now you're going to start to see more debt issuance, Alphabet on a massive 4-month spree, $60 billion worth. On top of that, more IPOs. This is where the story starts to change in the equity market as well. The members of the S&P are still the same big contributors, the same big names that we've been talking about for the last 10 years, but they're different, and they're doing different things. They're spending less on capital returns, they're spending more on investment, and they're now tapping the bond market. And Alphabet's a really interesting example of that, because now they're looking for different pockets of liquidities in different markets, going to Canada, to Japan, to Switzerland, to the UK, just trying to find more and more space to make sure this market doesn't push back.
And they've been received really well. I mean, the numbers are massive, and yet their balance sheet's that much more massive, and people around the world really want to get into their debt because, frankly, it's a good opportunity, and tech debt has outperformed. It's the dispersion, the K-shaped in both consumers and also in companies and also in debt issuers, where suddenly you're going to have a number of names that cannot raise money, that cannot refinance, and what is going to happen to those companies? So can you see a default cycle within a boom market? Can you see this kind of shakeout at a time of otherwise strength? So these are some of the reasons why people are getting very excited about active management.
Cheat guide to today's session so far. Bond yields near session highs, equities near session lows. On the S&P, we're down by about 1%. On the Nasdaq, negative by 1.5. Coming up this hour, we'll catch up with Ulrike Hoffmann-Burchardi of UBS, with stocks cooling off from their record-breaking run. Ted Mortonson of Baird on risks that could impact the tech sector, and Scott Croner of Citi on why his preferred AI trade is the Nasdaq 100. What a rip-roaring rally we've seen there through this year. We begin this hour with stocks sliding and global bonds selling off as inflation fears ramp up. Ulrike Hoffmann-Burchardi of UBS writing, after a decade of mega-cap dominance reinforced by passive investing, it's now time for active. Ulrike joins us now for more. Ulrike, good morning.
Good morning.
Let's talk about that statement there, that quote. That's important. What's changing, do you believe, that leads to this moment?
Yeah, I think we're at a precipice of new leadership in the equity markets. If we look at the MAX 7 this year, it's quite a dispersed picture. You talked about dispersion. We also see this underneath the surface in equities. So 2 of the MAX 7 are down. We have, of course, 2 real leaders that are outperforming the Nasdaq, but we haven't seen this before. And so we think AI is increasingly the dividing line between winners or losers in the equity market. And what we're saying is AI is tech, but tech is not AI. And so for us, just investing in the Nasdaq 100 is not sufficient. We want to invest in the AI leaders, and those are companies that are in the semi-supply chain, but also, of course, cloud computing.
Can we build on that a little bit more? We needed the bust in .com to establish the ultimate winners of that era. Do you need the bust in this one, or are we already establishing who the winners might be?
So I think that's a great question. I think so far, when we look at AI, we have been in the opening game of the AI chess. Anybody can win in the opening game. I think now we are starting to enter the middle game of AI. And in the middle game, some players, some pieces are falling off the board. And I think we'll see that increasingly in the course of this year.
I'll name some of the companies that are struggling at the moment. You named some that are down on the year. Meta's struggling. Microsoft's struggling. Alphabet is really not struggling. I don't expect you to be single name specific, but just describe the kind of companies that are succeeding and the attributes they have, and the ones that are struggling and the attributes they don't have. That's the dividing line between one or the other.
We increasingly focus on the physical economy, because if you think about what happened with software, could happen to other parts of the digital economy. If we have more agentic AI, what role will the internet play? Is it going to be a transaction layer, Or is it going to be still optimizing for human attention, right? The internet right now is optimizing, converting our attention into transactions. But if agents execute more and more of our consumption decisions, how is that model of advertising going to evolve? So for us, those are some fundamental questions. So we prefer the physical sectors in general, not just in AI, but also in industrials, materials, utilities, that are empowering this AI revolution.
How concerned are you about yields in the bond space that are creeping higher, as a lot of the expansion plans are predicated on being able to raise money in a relatively cost-efficient way in the bond market?
You always have to watch yields. I mean, the Achilles heel to any prolonged equity market bull run are rates. So definitely worth watching. Oil, of course, we have now Kevin Warsh coming in. He wants to think about shrinking the balance sheet. Those are all issues that are weighing on the long end. But we do think that we'll see one more cut this year. Kevin Warsh is coming to the Fed at the point where it's been most divisive since 1992. And we think that's going to continue. So we don't see a rate hike or cut. It's just going to be gridlock in our view for the next few months until December.
There are a number of bond traders that are shaking their heads out there who are listening to this and saying, that's not what we're seeing and that's not what we're pricing. Just to do a bit of scenario analysis here, if the Fed were to adopt a hiking bias or actually were to signal that that was a very likely possibility, how much would that dampen your view for equities to keep rallying?
I think we need to see a little bit more than one hike. If you look back at 99-2000, right, it took 5 hikes for the NASDAQ to turn. So it would certainly be concerning, but it probably wouldn't change our base case.
So I guess that here's a question. If you're expecting yields to go down, and it wouldn't matter if yields would go higher, what would shake your confidence, given the fact that we're seeing certain companies that are clearly struggling, and there is this issue of how long run rates can really keep expanding at the pace they have been?
I think you need to see a sustained increase in rates, and quite a bit higher than what we have right now. Maybe the 10-year above 5 would be more of an issue for us. But I think at this levels, we still expect 4.25 by year end. Again, if the economy starts to slow, which is what we are expecting in the fourth quarter, where the fiscal stimulus is going to fade, we probably have some pressure on the labor market from AI. All of these things together, for us, suggest that we may at least, our base case is that we have one more cut in December. Not before then. Powell by that time might have also left. That may give room for another opening on this.
Who knows?
Right? So there's a lot of variables that we are looking at, but that's at least a possibility to
Some of this, of course, is highly dependent on why you think yields are rising. And I've been reading some of your past comments, your previous comments, that maybe we are on the cusp of a cyclical upswing in this economy. Do you think we are, and what's powering that?
We think there are 3 pillars to this current upswing. One, of course, is fiscal expansion globally, the 4 largest economies in the world fiscally stimulating. Then secondly, we have this AI capex boom. AI capex in the US is 2.5% of GDP now and rising. And then thirdly, the consumer is still spending. We saw retail sales up 0.5% month over month. So you have the governments, the corporates, and the consumer spending. To your point, if rates go significantly higher, all those 3 may be called into question. So we're watching, but it's not our base case.
It's hard to fight. It's good to see you. Thank you. Thanks for being here. Ulrike Hoffmann-Burchardi there of UBS. 10's at 450. HSBC has called that the danger zone. UBS just saying that maybe that needs to be closer to 5% to be a real threat to this equity market.
Yeah, Lori Calvasina of RBC saying the same thing. 5% really is the key trigger point for some sort of material selling. Either way, you raise a good point, John, which is it depends why. And if you do see a reacceleration in the economy, does that come with commensurate acceleration in the labor market, as well as potentially consumers' ability to absorb some of those price increases? That's the structural dilemma a lot of people are analyzing.
That's an important moment for the incoming Fed chair. If you shift to neutral from an easing bias, how do you communicate it? If you're just worried about inflation, that doesn't sound great. But if growth is better too, that's a better story to tell.
It's a better story to tell as long as consumers are participating. That's why it's such a fraught moment. If people are losing their jobs because of AI and they aren't able to spend anything, well, then is this really one that you want to hike into and then crimp their borrowing power all the more?
Yields up 7 basis points on 10s, approaching 455. With an update on stories worldwide with your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. President Trump speaking to reporters on Air Force One as he returns to the U.S. from China. Trump discussing his talks with Xi that covered the war in Iran, as well as the situation with Taiwan.
On Iran, it's very interesting. He feels strongly they can't have a nuclear weapon. He wants them to open up the trade. On Taiwan, he does not want to see a fight for independence because that would be a very strong confrontation.
Trump going on to say he will make a decision about arms sales to Taiwan soon. The president also saying he discussed AI guardrails with Xi during the summit, including NVIDIA's H200 chips. Trump says China hasn't approved purchases because they want to develop their own. And Apple and OpenAI's partnership is on the rocks. Sources telling us here at Bloomberg, the AI startup is exploring possible legal actions after not seeing the expected benefits from its deal with the iPhone maker. No final decision has been made. That's your Bloomberg Brief. John?
Yeah, Hira, thank you. Thanks for the update. Up next on the programme, the Morning Calls Plus. We'll catch up with Ted Mortonson of Baird on what could threaten the historic rally in chip makers. From New York City this morning, good morning.
We think that the AI theme is best expressed right now amongst the many ways to express the AI theme in U.S. large cap growth. You have high earnings growth, high margins, and the valuations, well, for large cap growth in the U.S., they're below the 5-year average. It's not bubble-ish valuation in my mind.
Well, here's the move this morning, pulling back. An equity market rally stalling, running into some problems in the bond market. Futures down by 1.2% on the S&P. Session lows down by 1.7% on the Nasdaq. Europe getting hammered in today's session, approaching the back end of that particular close over in Europe. In the bond market stateside, Treasuries, 2s, 10s, 30s, yields up across the curve, up 4 basis points on 2s, 4%, 10s, up 7 basis points, 4.55 on 30s, 5.1%. That's the move stateside, highs of the year. Check out the global move on a German 10-year, the highest since 2011. On a UK 10-year, the highest since 2008. On a Japanese 10-year, the highest since 1997. We've got a global bond market problem.
And part of that is because some of these economies are even more affected by higher oil prices. The suggestions this morning are potentially escalatory, with President Trump saying that his bar essentially is a lot lower to go in, but also a question of whether the Strait of Hormuz will be reopened at any point if, as President Trump said, it's not our problem. You're seeing oil prices go up. You're seeing PPI come in hotter than expected around the world. And in tandem, you're seeing bond yields rise to the highest levels in decades.
Look at the UK. Honestly, just bring up that board again. 17 basis point move. That is not a pretty picture, is it? And every single time this happens, you see a much bigger move in the UK. It's on the edge of being something else, not quite DM, it's something else right now. And that's a problem for leadership in that country.
It was the conversation we had before where it's increasingly acting like an emerging economy, especially given the uncertainty around the leadership. Keir Starmer potentially being challenged by Andy Burnham, the Manchester mayor, who has said in the past that the bond market shouldn't have the control that it does over the market. This is the bond market's response, or at least shouldn't have as much control over policy. Well, the bond market's response this morning is, OK, let's see how much you can handle.
That's slamming the brakes on the equity market rally. That's the price action. Let's get you some morning calls. First up, HSBC upgrading Cisco to buy, highlighting stronger AI infrastructure momentum. Your second call from Citi, raising its price target on Applied Materials, noting increased earnings visibility. And finally, JP Morgan raising its price target on Dow, citing the reversal of memory-related concerns. Elsewhere, the SOX index surging 70% so far this year as demand races past supply. Bloomberg's Ed Ludlow joins us now for more. Ed, welcome to the programme. Some jitters in the tech space this morning, but wow, what a rally we've seen over the last month or so.
Yeah, and so we start to ask, why did the rally sort of stop from Monday night onwards? You know, there were very broad-based reasons, shortage in memory, a very broad-based AI-fueled rally in that 70% until the beginning of May. And then that first 2 weeks of May, I probably, John, spent more time looking at charts than I normally do, but if you go back to sort of the end of March, NVIDIA is the biggest contributor to a lot of that, right? Not just for the SOX, but for the S&P 500 and NASDAQ 100 as well. And the more recent enthusiasm in NVIDIA was that the president would go to China irrespective of whether Jensen was on the plane or not, he ended up being on the plane and achieved something of substance. And if you look at the markets in the moment, one session a market does not make, but there's clearly a disappointment in the here and now of what actually was achieved. And Yahira gave us the comments from the president that while H200 was discussed, China wants to support its own domestic industry. So that's a big part of it. But also the bar's now a little bit higher. So instead of going from increments of like, is NVIDIA a $5 trillion company or a $6 trillion company, we're very much focused on the fact that it hit 5.5 trillion, and that was a bit of a ceiling in the moment. We're in overbought territory for much of that, not just in your NVIDIAs, but some of the large caps, like your prior guest mentioned in that clip, and some of the smaller names in the semi industry as well. We've kind of hit a top for now.
What's $500 billion between friends, eh, Bramo?
Well, we'll do
a couple of days of trading?
Let's do a whip around and we'll see what we can raise. To me, the idea that you can raise $900 billion, or at least, or you could increase your market cap in 7 trading sessions is bonkers.
Ed, thank you, buddy. Looking forward to the programme. Ed Ludlow on Bloomberg Technology, coming to you in a few hours' time. Ted Mortonson of Baird writing the following: there's a hoarding of semiconductor supply ahead of price increases. Few are concerned about double or triple ordering. Shortages are a real concern. Ted joins us now for more. Ted, welcome back to the programme. Good to hear from you. That's a provocative statement for us all to think about. How are you thinking about that, just in terms of the price action that you're anticipating in the months and quarters ahead?
Well, it's truly been a melt up. I mean, on your previous guest, Ed put it well. I mean, if you look at the stocks, it's up 70% year to date. But more importantly, if you look at since April 7th, the stocks is up 52%. Actually, that's a pretty good multiple years of performance in a month. So we've had this real melt up. I think the other thing is, where I talk to my clients, if you look at the semiconductor index in relationship to U.S. GDP, during the dot-com bubble, we were probably 15%. The semiconductor complex was 15% of the GDP. If you look at the global financial crisis, call it 7%. If you look at COVID, we were at roughly 25%. Today, we're at 50% of GDP. So there's a fair amount of good news based upon the really, really strong fundamentals. I sit on 70-plus conference calls during earnings season, and there's been 25 bellwethers that have actually killed it on earnings. So the macro is strong, but I think there's roughly 6 or 7 macros that the street's really not looking around the corner on.
What are those macros that you're thinking of?
Well, number one, I would say inflation. Every single call, and you've talked about it all morning on the 2 and the 5, the 10s, the Japan and the UK yields. Inflation in tech is everywhere, and I think everybody knows it's in memory, but it's everywhere from substrates to commodity ICs to just availability. Number two, I think if you look at models. Where my worry is just in the EU and EMA, it's 30% roughly of all diversified tech companies. If they're having problems from the economy side, I think a lot of these models could be stale over the long term. Number 3 is shortages. If you listen to the microchip call, Steve Sanghi basically said his die inventory is going to be depleted in a few months. We're running into, because of the Straits of Hormuz issue, as a contributor, we are running into some shortages. Could we see kind of a COVID golden screw issue happen in Q3? Possible. Number 4, and I think this is the one that people kind of put on the back burner, but since the robust infrastructure build on data centers, access to power is getting much more difficult. And the last 2 is just more of the Iranian conflict. The street is totally bought into this taco trade.
Ted, I'm wondering also where Taiwan ranks on this, given the fact that we just came from the meeting between Xi Jinping and President Trump, and there are real questions over China's desires when it comes to Taiwan. Is that entering into anybody's minds these days on the earnings calls or anything else?
No. Right now, everybody's overweight TSM because they control all the advanced logic production basically in the world, and they've they've perfected 3 and 2 nanometers. So everybody's there. I don't think the geopolitical's right now into the semiconductor thought process.
Do you think it should be?
I think over time it should be. It all depends what happens in the next couple months, in the Ukrainian conflict and the Iranian conflict. And, if it gets spicy, I think the scenarios may change.
Ted, just a final question. You went through a range of potential constraints, shortages, power constraints. We've been talking about the potential of capital constraints as well, maybe some pushback in financial markets. Lots of people are having this debate right now about what we might hit first. What do you think we might hit first?
I think it's the capital restraints. I mean, just from the buy side perspective, look what happened yesterday with Cerebras. I mean, but, look who's coming. You possibly have SpaceX coming relatively soon, followed by Anthropic. I mean, you've got a lot of very significant tech IPOs coming. My worry is that we drain the liquidity of the equity markets, and it becomes much more difficult. There's going to have to be some PMs that really look at their portfolios and see what they have to sell to fund some of these IPOs.
Interesting. It's kind of where my mind's going as well, Ted. It's good to hear from you. Thank you, sir. Ted Mortonson there of Baird. We've been talking about this throughout this morning, going from asset scarcity coming out of the pandemic to maybe just sort of abundance. All of this issuance in the debt market, all of this issuance in the public equity market as well in the year to come.
Yeah, and what Ted was just saying there, if someone wants to get in on OpenAI or on SpaceX when it actually does go public, do they have to sell Meta in order to do so, right? Are they going to have to sell Microsoft shares? I mean, how do they make room for this? And how exactly are the indexes going to be composed? Is this going to be now 30% of the weight, these new IPOs that suddenly are going to come and subsume liquidity from other areas? It's a real question. It's a different dynamic.
That's the supply on the horizon so far, just tracking demand. Demand for the IPO, solid, performance good. The one we saw yesterday, demand for the debt from the hyperscalers, solid so far. We just keep tracking the demand, see how it stacks up against a wall of supply that might still be coming. Coming up on the programme, Erin McLaughlin of the Conference Board as pressure builds on the US consumer, plus Danny has your morning movers. Cerebras pulling back following a blockbuster debut trading day. The open about 60 minutes away. The state of play, futures down, just off session lows. We're down 1.2 on the S&P, on the Nasdaq down by 1.7. Krinsky, Jonathan Krinsky over at BTIG, publishing just moments ago on SPX, and the record dispersion we're seeing. Now 8.56 above, 8.56% above the 50-day moving average. Only 47% of the names are above their respective 50 DMAs. This is by far the widest divergence on record. We've seen all the superlatives over the last week about this market, concentration, dispersion. Things have got really, really narrow.
You haven't seen bad breath like this in a long time, and I'm not talking about eating gum. It's this question of, can you have a sustainable rally driven by just a couple of names? I believe NVIDIA and Micron account for a significant proportion of all the gains so far this year. Just two names that increasingly are driving this. So at what point does that threaten this? And at what point, you asked this before, is it a feature or a bug? On one hand, people could say it's a feature and let's just pile in. And ultimately, that has been what's been ruling so far this year.
Well, upend in the equity market isn't really that this morning. It's this. It's the bond market. Stateside Treasury yields are near the highs of the year, up by 7 basis points on 10s at 4.55. The move elsewhere, going international, even bigger in certain places. So highs of the year stateside. In Germany, the highest level we've seen since 2011. In the UK, since 2008. In Japan, the Japanese 10-year, overnight, the highest since 1997. Some major moves internationally.
These are the economies that are actually more exposed to the increase in commodity costs stemming from the Strait of Hormuz. And you've seen this in hotter than expected PPI prints in Japan, following the one that we saw in the United States. In the U.S., there are buffers. We're an oil exporter. We are an oil producer. That isn't the case in Japan. That isn't the case in the European continent. And that isn't the case in the United Kingdom. So it becomes that much more of a stressor at a time where there is fiscal limitations with respect to the deficit. And frankly, a lack of will on the part of monetary policymakers to stave this off from a demand destruction side by raising rates.
Wherever I look right now, I just see capital needs and supply. This has been a feature of the program this morning. Wherever I look, that's all I see. Alphabet tapping the Japanese bond market, going to the debt market, raising $60 billion in the last 4 months. across a range of regions. Sarah Fryer of OpenAI, the CFO, speaking to Bloomberg, saying, yes, we've just had a record round of fundraising in private markets, but we might have to go again. The Treasury market, big deficits here stateside, even with a strong economy, and that's been the new normal now for a number of years. Japan's got its own problems. The UK's got its own problems. Germany in the mix in the last 12 months, pledging to supply more. Wherever you look, the IPOs, supply, a wall of it in the next 12 months.
Building is expensive. There have been decades where we have not been building, where it has been fiscal expansion, monetary repression, and this idea that we are living in a financialized market. You put your market into stocks or into bonds, you're going to gain money, and that's it, and you can go on your way. The bill's coming due. You have to build stuff in order to keep the economy going in an AI era, and increasingly, that is what we're seeing. Right now, there is enough capital out there to fuel that. The fear is, what happens when there's not, or if there's not? And that ultimately hasn't happened, but you're seeing just people begin to raise that possibility.
So far, demand's been good. Demand has met the moment, but there's a wall of supply on the horizon we'll keep on tracking. And for the man at the top of the Federal Reserve, now Kevin Walsh, an interesting first day at work for him. 1 hour away from the cash open, let's get you some morning movers. Danny Berger has more. Hey, Danny.
Hey, John, perhaps the poster child of wanting and finding a way to fundraise is Cerebras and their blockbuster IPO yesterday, the AI chip maker rallying 68%. Some of the air coming out of that this morning, as it does the entirety of the semis trade. Cerebras down 2.9%. Intel's one of the worst performing, down 5%. Higher bond yields just weighing on this rally that's been record-breaking in some measures. And you have the outcome of the U.S.-China trips. No necessarily big action when it comes to semiconductors and NVIDIA itself, which is down 3%. Elsewhere this morning, Dexcom, they are a glucose monitoring device maker for diabetes and for others. They reported earnings and they were pretty strong, but the excitement here is that Elliott is taking a stake in Dexcom. They've already appointed board members. They're pushing them to make more efforts to expand their margins. We're going to have the CEO on open interest in the 10 a.m. hour, and those shares are up 5.5%. Finally, Papa John's. Those shares also moving significantly higher, up nearly 10%. The firm Earth, alongside one of the biggest franchise owners of Papa John's, reportedly in talks to take Papa John's private, that according to Reuters. So again, those shares rallying pre-market, John.
Danny, thank you for the latest. Danny Berger there. More from Danny around the opening bell as her and Matt Miller guide you through the open in the next hour or so. A new era taking shape with the Federal Reserve. Fed Chair Jay Powell ending an 8-year tenure as Kevin Walsh steps into a Fed facing an uncertain path ahead. Mike McKee joins us now for more. Mike, welcome to the programme. You and I have talked about this with various leaders at the top of various central banks. They all face their own test. Is that test already brewing in this bond market for Kevin Walsh?
Oh, it absolutely is. And with the economy being where it is, it's going to be a real challenge. Let me start with some good news, bad news. The good news for Kevin Walsh is the Empire Index from the New York Fed, manufacturing in the New York Fed region, comes in at a 4-year high of 19.6. But prices paid, the bad news, is at a 4-year high of 62.6. So as Kevin Walsh comes in, this is Powell's last official day as chair, and he will be staying on as a governor until who knows when. We don't know when Walsh is going to actually be sworn in. Sometime in the next few days, depends on when the paperwork gets done. And his first Fed meeting is June 16th and 17th, so everybody's going to be keeping an eye on that. But he walks in with these black clouds of inflation hanging over his head and Donald Trump's tweets hanging over his head. He's got to contend with the fact that inflation is moving away from its 2% target, and we had those dissents at the last meeting from members of the committee he's now going to oversee, saying they think they should be warning people maybe we have to raise rates. Plus, as far as the inflation is concerned, we've got more tariffs coming up this summer. And out there, the Justice Department still lurks. Jay Powell staying on because of that. And there's the question of whether the Fed can remain independent. And what about his plans to shrink the balance sheet? That's his signature move other than with interest rates. And already, we're seeing a lot of pushback from the people he's going to be working with. Michael Barr last night, shrinking the balance sheet is the wrong objective. And of course, Chris Waller recently saying that the scarce reserves regime would be stupid and massively inefficient. I don't have a lot of confidence in the idea of shrinking the balance sheet, according to John Williams, the New York Fed president. So at this point, he's got a lot of opposition in a lot of areas, and he's got a lot of economic problems that would prevent cutting interest rates anytime soon. So he's wanted this job for a long time, and now he gets it, for better or for worse.
Baptism of fire, maybe, in the bond market. Michael, thank you, sir. Appreciate it. Consumer confidence sitting near all-time lows as inflationary pressures continue to build. Erin McLaughlin of the Conference Board writing, we are seeing more cracks because of tariffs and oil and gas prices escalation will be baked in for months, even if the Strait is open tomorrow. Erin joins us now for more. Erin, good morning. It's good to see you. We've been talking about markets facing a positive supply shock. The economy is experiencing a series of negative supply shocks. So you've got a lot of individual companies raising a lot of capital, pushing demand into a supply-constrained economy. Doesn't all of that just equal inflation for the next 12 months?
Absolutely. Unfortunately, U.S. consumers are dealing with the shock from tariffs, which are still in the supply chain, and now an oil shock. And we don't expect tariffs to go away, and we don't expect the oil shock to resolve anytime soon.
Where are the higher prices showing up now, and where do you expect them to show up in the future?
Okay, so we know high prices are showing up at the pump, but they're also showing up for companies with diesel fuel, and jet fuel has doubled, since the beginning of the year. We're seeing higher prices with food, and we expect that to continue. Now, that's obvious because food needs to be transported, right? The cost of transportation is going up, but food is also packaged, and so many things are packaged. So all those petrochemicals that come into plastics, that go to those Asian markets, come back to the U.S., those are under increasing pressure due to the Strait of Hormuz.
That said, it seems like consumers are still buying. It seems like there hasn't been a huge pushback in terms of consumers going on strike or limiting their purchases, at least not in aggregate. We just got retail sales that showed that still demand. So at what point, or are you starting to see already some pushback or consumers that might be withdrawing some cash from this?
Right. So when we look at yesterday's retail sales numbers and we take into consideration the inflationary portion of it, they are slowing down. So we're already seeing retail sales slow down. We know that consumers, more than 95% of Americans drive to work. So they need to buy gasoline. They're still going to buy food. Our consumer confidence index still has, the last thing people want to cut back on is sort of restaurants and bars and takeout food and pet care, as I was telling you all earlier. So we know that they're still going to prioritize some of that, but it's some of the larger purchases that we know folks are going to cut back on. We also know that it's consumers that are around $125,000 annual income and up that are the ones that are really, keeping the economy going, and they're the ones that have kept the economy going for the last few years.
How much has the perception of inflation changed over the past 7 years or so? There was a time when it was predictable what prices would be at any given time. Then post-pandemic, that was flipping around all over the place, a huge inflationary wave. And now it seems like it's harder to gauge what anything's going to cost at any given time, so people don't really know. So a lot of companies can kick things up if they want to.
Yes.
How much has the psychology around this changed?
I think consumers, certainly pre-pandemic, inflation really wasn't on their mind at all. And so the pandemic was sort of shocked the consumer into realizing that this is a problem. But part of the issue is that even when we saw it sort of come down, these other shocks have been in place. And I think consumers are, becoming very wary because they know that there's probably more shocks to come. And a lot of that is driven by geopolitical issues. We are dealing with the unknown. For example, if we have a series of hurricanes and we see natural gas and oil exports and markets in our Gulf, impacted by that this summer or fall, that could be another shock. And so there's the known and the unknown, and there's a lot out there.
And yet Kevin Walsh calls inflation a choice. So what is his North Star going to be in the next several months, the next several quarters?
Well, we don't expect the Fed to cut. We know that that the Fed and, our new chair, Walsh, has a very political, sort of environment they're walking into, and it's very unknown. But we don't expect interest rates to come down. We don't expect a cut this year.
Do you expect them to go up?
I don't think so. But again, we really don't know what's going to happen when we look at 4, 5, 6 months out. And it's interesting because, when we take our consumer confidence index, it's a flashpoint in time. It's a 2 or 3 week survey period. So there's times when, just in the last month, things felt like, okay, they're getting better. Labor market numbers are looking good.
Yep.
There's a truce. And then, a few weeks down the line, a month down the line, and we're entering 12 weeks of this conflict.
Do you see numbers from you, Mitch, and just roll your eyes? What's that survey all about? Record lows. I struggle to get my head around that.
There's room for different numbers and different points of view.
You're not biting,
certainly.
are you? Never mind. All right, Erin, thank you. Erin McLaughlin there at the conference board. I imagine they are. Like, here's you, Mitch. Here they go again. Record lows. I really struggle with that survey. Record low sentiment, all the bad things that have happened in the last 40, 50 years.
People have looked at that survey and said increasingly it has a political element to it. It speaks more to the polarization and the sort of tribalization of politics. I'm just still thinking about this idea. If people don't have a sense of inflation coming down, and if potentially there's another shock that could come later, why would you delay a purchase? If you don't have faith that that price is actually going to be lower in the future. This is the kind of concern. Welcome, Fed Chair.
That's why consumer expectations are so important.
Right. That's the reason why people are watching these things.
We're looking for clarity from Kevin Warsh, from the Fed Chair, the incoming Fed Chair. And I think it's really important. That's a feature, I think, of the bond market today. That's where we've lost one of those anchors. We don't really know the reaction function of Kevin Warsh, the Fed Chair, because he didn't really articulate too much of it in the hearing. There was a failure, I think, in the hearing of the individuals there for various reasons on a Senate Banking Committee who didn't really get to I think, the bigger issues about how he'd respond to incoming information at any given time.
That's why there's a tension right now. You've got the front end of the yield curve implying rate hikes, but you have the S&P implying rate cuts or just rates on hold for the longer term. And then you have longer term rates, which are determined by a global trend that really has been whipsawed by some of the oil pricing that we've seen. So you put this all together, it is kind of messy and is ripe for some sort of shakeout one way or another.
It's going to be a big meeting in the next month, which is why I'm off for vacation to watch the World Cup. But, it's going to be a big meeting.
You're not going to the World Cup, are you?
Let's give you an update on stories worldwide with your Bloomberg brief. Yahara has more. I'd never pay that, but I will watch it on TV. Hey, Yahara.
Hi, John. We are seeing Cerebras shares falling 4.25%, but that's after surging yesterday 68% in its trading debut. The AI chipmaker raising $5.5 billion in this year's largest IPO yet. The surge driving the company's market value to upwards of $67 billion. The NFL releasing its schedule for the 2026 season, kicking off with a Super Bowl rematch between the Seattle Seahawks and the New England Patriots. The season opens on Wednesday, September 9th. And workers at the Long Island Railroad are threatening to walk off the job tomorrow. Contract talks between New York City's transit system and the nation's biggest commuter railroad hitting a snag over cash payments versus wage increases. That's your Bloomberg Brief. John.
Yahara, thank you. Thank you for this morning and the update. Up next on the programme, we'll set you up for the day ahead, plus we'll touch base with Scott Kroner, the city, on why NASDAQ has more room to run. From New York City this morning, good morning. You're watching Bloomberg TV.
You're seeing, the memory name is basically saying they're entering into 3 to 5 year long-term agreements with the hyperscalers because there's so much demand for it right now. And why that's so important is because it reduces the, price volatility, and it gives us much more earnings visibility than we've ever had before.
That was Alastair Pinder of HSBC, bullish on this equity market. HSBC, one of 6 names since the start of this war to upgrade their price target on the S&P 500 for year-end. Equity futures pulling back from all-time highs this morning. We're down by 1.2% on the S&P. On the NASDAQ, down by close to 2 percentage points. The jitters, the epicenter for them, coming out of the bond market this morning. 2s, 10s and 30s. Yields up across the curve. 2s through 4%. Up by 5 basis points now, and the pickup continues, now up by 8 on 10s as we get closer and closer to the cash open.
But this is a global issue as a result of oil prices being higher, but also the idea that growth isn't slowing materially enough to offset some of those inflationary pressures with demand destruction. The result globally is a bond sell-off, the likes of which we haven't seen, at least in certain places, since 1996.
Almost 10 basis points higher in Germany, almost 20 basis points higher in the UK, in Japan. PPI coming in really, really hot. Problems are building. This bond market at the moment, not so much treasuries, but elsewhere, certain pockets of it on the global scene, just feeling a little bit untethered at the moment.
How much is the Bank of Japan saying we should have just hung on to those bonds? Why did we let the market out of our control? You know, this is what happens when you let them run free.
That's the bond market this morning. That's what a market is, right?
Something like that.
They're always thinking about stepping in. Anyways, we count you down to the opening bell. Coming up over the next few days, your trading diary looks like this. Today, Fed Chair Jay Powell's term coming to an end, and Philadelphia Fed President Anna Paulson will be speaking, so look out for all of that. Looking ahead to next week, earnings, Nvidia, Wednesday, the big one. Then you've got Target and Walmart in the mix as well, so some interesting detail coming out of the retailers in the next week or so.
Yeah, right now we're going to see whether we got the same kind of retail demand that has been the real hallmark of the past couple of weeks. Although, how much is it also the K-shaped in the retail sector, the haves, the have-nots, with some of them really deploying incredible technology?
Should we talk about the Nasdaq? What a record run. Scott Krohn of the City with this to say. We view the Nasdaq 100 as a preferred play on the AI build-out. Fundamental expectations have demonstrated consistent improvement. Scott joins us now for more. Scott, welcome to the program. We've heard the complaints. We've seen people nitpick at the Nasdaq and the tech names, say it's too narrow, too concentrated. Scott, what's the pushback? Why stick with the winners?
Well, I think that what this market is doing, for all the noise that we're contending with, whether it's the inflation, the macro outlook, the Iran conflict, oil prices, so forth, you know, I think the guiding light here is that as go earnings and earnings growth, so goes stock price action. And that's what you're getting out of the Q1 reporting period, is improving visibility and confidence, therefore, in this mega cap growth cohort that is attached to AI. So if you're looking at a sort of a mixed macro backdrop and you want to go to where the fundamentals look like they have room to continue to improve, this is where we're dialing in. It's big cap tech. And I think the Nasdaq is probably the best direct expression of that.
Scott, there's always this itch to rotate. You could feel it at the start of the year. Rotate into the other names, rotate and broaden out the rally. That happened to some extent at the start of the year. What changed once this war started?
Well, once the war started, you took it down a different path. Remember, we went into the year, Jonathan, looking at sort of a Goldilocks economic backdrop, soft landing with room for the Fed rates to come down. And what do we have? We have the inflation spike that's most likely triggered by the ramp in oil prices. And we've been talking about duration of conflict as mission critical. So as we're looking at going into 3 months now of the conflict, elevated oil prices and the obvious inflation read-throughs, you have a dual-pronged bifurcated market right now where you've got tech beating to its drum around the AI infrastructure spending wave, but then the rest of the market is acting much more like you'd expect around this nagging concern around higher for longer oil price influences.
Scott, does it make you nervous that NVIDIA rallied 20% in 7 trading days?
Yeah, I think on a short-term basis, Lisa, sure. You always, when you see moves like that, you have to expect that there's going to be a time and a pause to digest that move. But you know, when you look at a stock like that, you look at the price action for the past 8 months, it's been mostly sideways. So one of the ways I'm thinking about this is that, you know, I think the past several years, what we've seen are these massive moves in that cohort of stock, okay, that then takes time for the fundamentals to grow into the price action. Then you get to a point, you get renewed confidence in the longer term growth outlook, and you can rally again. So, you know, I think there's a lot of repositioning at work and has been for several months. Within this semiconductor sector, NVIDIA had been the leader for some time. You now have other options in terms of how to position for the picks and shovels play within the AI construct. But I think essentially, yeah, on a very short-term basis, you have to be wary of the price action. But underlying the structural component here is still a pretty decent-looking outlook in terms of the next couple of years for sure.
Not to end on a philosophical note, Scott, but how worried are you that we don't really have an endpoint in terms of what the ultimate goal is? When is enough AI? When is it sort of the ultimate endpoint where we see the new world in an AI construct that we can determine who's going to be a winner and loser, not just in tech, but also in corporate America and beyond?
Yeah, you know, it's a really good question, and I think we're going to be grappling with this for the months and years to come, probably. I think there's, and we've been talking about this, Lisa, there's certainly inertia right now in every C-suite in America to make sure you've got your AI strategy and you're pursuing it. But you have to expect that along the way, there's going to be, you know, some pause in terms of how you look at the implementation of it, how quickly you can find solutions that drive productivity, and then we're going to have to be on the other side looking at how this plays through to the labor condition. So I think what your point's spot on, but what we have to be prepared for is that the underlying inertia right now looks like it's pretty set to continue for the foreseeable future. But this isn't going to go on forever, right? So we do have a window here where we're going to see this spending benefit drive the fundamentals, but ultimately, gosh, we were talking about this a year ago, where we have to get to is a point where the AI influence is really along the lines of lessening some of the historic earnings volatility that we've seen in much of corporate America. If you can do that, then you end up justifying a higher for longer valuation for U.S. equities.
Scott, 30 seconds. Can your bullish call live with 450 on a 10-year?
No, I mean, look at so 450 probably. Okay, we've learned in the past couple of years 480 on the path to 5 is no good. So as we hit this 450 level ish, we're going to have to be very careful in terms of what the trajectory is going here. But there's no doubt that I think the interest rate backdrop is certainly going to be a headwind here. And again, what I would say, Jonathan, is that one way you offset the valuation implication of higher interest rates is stronger earnings, right? So we are going to have this tug of war going on. But yeah, as we push through 450, I think the caution flags start going up a little bit.
Seeing that this morning. Scott, thank you, sir. Scott Conant there of Citi. Thank you very much. Coming up next week, stacked lineup on Monday. Look out for that from New York City this morning. Good morning. Have a wonderful weekend. This was Bloomberg Surveillance.